levels. Yep, yeah, our chart that I pull up does have Fibonacci levels and all the popular technicians strategies, moving averages, support and resistance, and as well Fibonacci levels. So I think Fibonacci levels and things of that nature are good for finding where the market may end up. But as you know, all of those come with predictions in both up and down. So it doesn't really tell you which direction. It just tells you likely levels you may end at. So I like to use fundamental analysis to predict that.
And you are live.
Okay, great. Welcome to our May 4th, 2020 Trade Alert Update. Today we're going to start off by looking at the trade alert document. Then I'm going to look at the top news. We'll take a quick break to review our different product plans with Dean. Then we can deep dive into charts, news, and do a more in-depth Q&A. Okay, so today we sold our emerging market put option for a 700% gain, somewhere in that range, depending on where exactly you bought it. But we're still long that FXI put. So we have a good position betting down on China. We're watching the rhetoric from Trump and Pompeo rack it up higher. And at the same time, the Chinese are becoming much more aggressive with their commentary as well. So one of my two favorite trades at this point is to bet that the bond market goes sky high and that geopolitical tensions with US and China get much worse leading into the election, which again makes us want to be short the Chinese stock market. So that's our big positions that I see playing out, and that also indicates that the US stock market will be in some deep trouble for quite some time as well due to the bond market move. So we'll cover the analysis in great detail today. But the only change I've made is to sell that emerging market put. And again, it was a substantial return, but a tiny position. So we didn't have a lot riding on that trade. But we have increased that position with a more targeted FXI puts. We'll look at that in a minute. Expect to sell the VXX put expiring this Friday on Wednesday. That position did go against us, as Jack Tan is pointing out, and is a position I will continue to build on a weekly basis until we get a few confirmations that the next big leg down is here. And we'll talk about what the market has going for it to stay at these levels and why that could make the volatility index drop, as well as how we're positioned to profit from a big leg down in the stock market. So again, we've sold the emerging market put option for a 700% gain and remain long all other positions. Plan to sell your VXX put, which expires this Friday on Wednesday. And then also expect to increase our SPY put exposure and TLT call exposure within the next 14 days. So that's really what I think will be our timeline for achieving that. Now, if you're a new member, obviously you don't have the previous emerging market put option, but what you can do today is build out the full portfolio based on multiples of $75,000 following our strategy. All trades marked buy and hold are positions that we do endorse to build today without any delay. So a lot of people want to know when to build each piece of the puzzle, and really my best advice is to build the complete portfolio in one shot and then sit back. So let's go through our trading plan today. So first of all, the top two trades are hedges that protect us against really the Fed. So the Federal Reserve came in with $2.5 trillion and buoyed the market back higher, although I do believe this is highly temporary. And again, we'll jump into the analysis of that. Timing can be difficult. That's why we have two different upside hedges. And note that this is marked as a basic membership. Later on in the presentation, we'll overview the different membership levels with Dean. But keep in mind, if you are a pro member, you take the basic trades plus the pro trades. So you do both. The basic membership's ideal for portfolios between 30 and 75,000. If you have a lot more than $75,000, you really want to be following or pro strategy because it does give you a much more advanced strategy that has bonds and stocks, not just a stock focused trading plan. So the first two trades that you can enter today are positions that are bullish heads. So we have one QQQ call option, and then we have 3 VIX put options. Now, the QQQ, our target to sell, is at the 230 level. So I think that's the highest we would see the QQQ go. And again, it's more of a hedge for the rest of our strategy against further upside risk from central banks manipulating markets higher when we know that the stock valuations are extremely frothy relative to 20% unemployment and probably profits crashing for the next several years for the majority of S&P 500 companies. Okay, so if you have a 70% consumer-based economy and you lay off 10, 20, 30% of the population, you just really can't expect the valuations of corporations to remain at the levels they're at currently. And last week, the big letdown was really Amazon. If any company should be thriving right now, it's Amazon. But because of the crisis we're all facing, even their guidance was poor and again, was one of the upsets last week for any kind of bull market push right here. Regardless, there is some news that does scare me for further upside risk. And again, that's why we still have a recommendation to hold this. Okay, so Dee Dee is wondering about the Fed. Yeah, we'll talk all about the Fed in a little bit. So right now you have 2 trades, one in which the market just goes flat, you do great, and one in which if the market goes higher, you're going to do very well. And that's the QQQ call option, target of 230. And then we have these VIX puts. And again, I do anticipate continuing to have one VIX put expiring every week until we do get more confirmations that we're headed towards the next leg down. And I'll cover what those confirmations look like and what our upside risks are in great detail after we get through the trading plan. So this short duration, 5/8/2020, $30 VIX put, we will sell Wednesday. And each of these others, we will sell one per week when I think we have the most ideal exit. Okay, so these are all still buy and hold if you're new. And again, if you took that last week, we watched that position double in P&L and then crash as we had disappointments from Amazon primarily. Also, Apple gave no future guidance as to how well they would perform, other than that they're going to do a lot of bond issuance and start to do more stock buybacks. But the $50 billion they're putting towards that would only really support about 5% decline in Apple. So, okay, the next set of trades are more important for the big picture. And this is where I really, truly believe investors are going to make the bulk of their profits in 2020 and 2021, at least in the immediate futures, is a vicious crash in stocks. Now, these are relatively cheap out of the money put options. In the next 14 days, I do intend to increase the Rick says, doesn't the VIX goes up if the volatility goes down? So volatility is the change of the speed. Yeah, I'll cover the VIX after we get through the trading plan, guys. So keep piling in your questions. We'll cover all that analysis later. But VIX does well if the market goes flat or up or just bobbles around. The call options do great if the underlying asset goes rocketing up. So one is just a change of speed and the other is a directional play. So different, but both relatively bullish and not bearish. The SPY puts are where I believe we're going to make the bulk of our profits in 2020. And that's because I'm predicting a massive stock market crash. Expect to add to this position with a much more expensive put in the coming weeks. There's a few things I want to let pass by us before I put in the last piece of the puzzle for our SPY puts. The strike I'm interested in will probably be around the 250 to 270 range. So it's going to be an expensive put and will be able to generate profits a lot sooner than these out of the money puts. And it'll be the last piece to our put options on the SPY. So we're holding back on that and have held back on that ever since the Fed went into aggressive quantitative easing. But as we know, they are rolling that back rapidly. So we'll talk about that in a moment. But these are important positions, and it's kind of like having life insurance. You don't want to try to time your life insurance, and that's exactly how I would look at your SPY puts. This is a once in a lifetime opportunity with this level of a crisis and this overvalued of a stock market to be positioned for the downside move ahead. So these are still a buy if you're new. And while we might be able to hit some quick returns playing the last breaths of the dead cat bounce is what I'll call it. That's what this is positioned for, short-term gains. This is for much bigger returns and further into the future, into later into 2020. Now, that's your basic portfolio. The whole setup is going to use less than 10% of your capital, far less. This position's much less than 3% if you're entering today. And these SPY puts, again, will add up to a very small position in total at this point in time. If you're interested in following our pro membership, because you have at least $75,000 to follow our trade alerts, we can put most of your capital to work. So in the basic program, you have maybe 10% of your total capital put to work at most, with the other 90% sitting back, ready to buy stocks at a great discount. So we'll be timing that as best as we can, but my fear is there's a massive stock market crash ahead. And that's again why we just want to have a bullish hedge for short-term risk and then get that life insurance on the stock market ready to profit from a big collapse. Al says, do we have access to what's on the screen? Yes, in your email, you have the full program. Jim's asking about debit spreads. So yeah, with a spread, you make a lot less than with just owning a put. So absolutely much more a fan of owning puts than spreads. Okay, and yeah, my target return on this set of put options is going to be between 500 to 5,000%. Okay, so that's the potential gain on each of these. The further you go down the list, the higher the potential return. And again, we'll talk about why this is really a once in a century crisis we're facing. That's at least 10 times, maybe 100 times worse than the 2008 crisis or the dot-com bubble, and why it may not feel like that right now when $2.5 trillion has been pumped into the market. But I promise you that is not enough to fix the underlying problem. And that $2.5 trillion is like taking money from your left-hand pocket. It's like moving money from your checking account to your savings account. That's not real money. Okay, so let's talk about what we have in store for pro members. And again, if you have over $75,000, we can put your capital to work immediately. And so the first position is 200 shares of the TLT ETF per $75,000. This is our largest position. The 400 shares of the GDX ETF represents about 16%. That's gold miners. This is really a hedge if they just don't stop quantitative easing ever. Now, I do think they will because it's critical to do that to fund the government's deficits they're issuing. But again, we're protecting GDX with a put. So we'll talk about strategy, timing, why we want to be early on GDX versus the rest, so we can sell it for a lower tax rate and rotate into silver when the time comes. If you remember that 2009 through 2013 gold silver run up, that's the exact same combo punch I see in precious metals in the coming years. But there's probably a huge wave of deflation hitting markets first. So that's why much more bullish on the TLT than GDX. Now, the USO position is very interesting. If the American government does not fix the oil problem stateside for WTI, the stock market crash begins much sooner and much more viciously. It is a huge problem and it needs to be bailed out. So this is really the last puzzle I want to see resolved by the US government before I put on that more expensive SPY put around the 270 to 250 strike. So I do anticipate this happening in the next 2 weeks, and I believe the solution will be a line of credit to the US oil companies. One, two, some oil companies going out of business, which again is very good for USO. And then three, the American government creates a new storage facility to store several hundred million barrels of oil and at the same time makes a large purchase. Okay, so if you put all those together, we're already seeing them. We've been pulling these highlights. They're already talking about it, planning this. That will give USO a huge spike, and is really one of the last few bullish things I see in the market to hold back a correction. The other risk is that we are seeing the Fed announce that by mid-May they're going to start doing corporate bond ETF purchases. They just teased it last month, and now they are coming in with the real purchases by mid-May. So we'll talk about the implications of that. The TLT options, we have a buy and hold on our 161 TLT put. The other positions that our older members have are in the hold position. We're going to quite likely sell those in the near future and then move up the strike to the 170 to 180 range is the new area I think we can blow past on the TLT. And then again, we want those call options to go into the money with leverage. Okay, continuing on. We also have our GDX position protected with the $28 put. And again, if you are an old member, you have two put options right now. We'll be looking to exit that before the expiration date. Currently, it's worth very little. So worst case, that one expires worthless. And we've had a great return on GDX. My intentions are to lock in the profits on GDX and buy an in-the-money put at the right time. So we will have potentially 3 open put options on GDX if you've been following me for quite some time, and you will have paid off all of those puts while just buying and holding that position. So again, we'll talk about the strategy with GDX, but do expect at the same time I add TLT call options as well as the big SPY put that we will most likely buy an in-the-money put on GDX to lock in all the profits we've enjoyed on GDX thus far. Okay, USO, you don't want to just buy naked. Okay, USO could potentially go to zero. So we want to lock in the maximum loss on this position when entering by buying an in-the-money put. So the idea here is we can buy the 300 shares of USO, which at this point in time is trading at $18.93, and then protect it with the $20 strike. This means we can put this position on, don't touch it till January 15, 2021. And if we are not in a huge profit by then, your broker is going to sell your shares, which you bought for, let's say, $19, and they're going to sell them for $20 to the underwriter of your put. So you're going to pick up $1 profit on the SPY, or rather on the USO ETF, but you're going to lose the cost of your put. So that's the maximum loss that you will realize the second you put on this position. Now our hopes is to see USO spike to the $40 to $60 range. Things are really going in our favor for that position behind the scenes. And then we will still remain long that put option, as I do believe the oil market's in a pretty bad position for the foreseeable year. So really, I'm expecting a short-term intervention by the American government that will spike the value of USO, and that will be our opportunity to sell that position in terms of the shares, and then again, remain long the put. Now, worst case, USO goes to zero or trades below 19, we will hold this position all the way to January 15th and allow the broker to exercise the option, which again will get you out at $20 a share, $1 profit on the underlying. You only lose the cost of your put. The next position I really like is the FXI, that's large cap companies in China, excluding Alibaba. So you've got a lot of really ugly real estate insurance bank companies in China who have really very, very poor books because of their real estate bubble. This expires right after the election. So this will be our quick hit on China. Do expect at the same time we buy the 270 to 250 level strike on the SPY, the same time we buy the in the money put option to protect our gains on GDX, I will buy us a 2-year leap on FXI, expecting that there's a good chance of a lot of geopolitical tensions with China leading into the election, but I do anticipate much greater tensions after the election. And again, that does depend on who's elected, clearly. If we have the Republican Party will almost without question have lots of chaos and lots of financial restrictions placed on China. If the Democratic Party is elected, we'll have to reconsider that because clearly there are some conflicts with that theory if the runner-up in the Democratic Party is elected. So this trade is one of my favorites because if we did go to the extent of outlawing investments into Chinese firms, because they don't allow us to audit these firms, and we're finding that many of these firms are reporting fake sales and revenues, well, then FXI could go to a value of 0. And what's neat about that is you're going to lose the cost of the put option, but walk away with the strike. So that's about a 30-to-1 return. You can risk 1% of your assets in this trade right here and potentially walk away with a total portfolio gain of 30% based on this single trade. Now, I do intend to, again, add a 2-year leap option for this position at the same time we put the final touches in on our put option strategy. Total allocation for the basic members, you have between 5 to 15%, depending on when exactly you built your position. And again, our goal here is to generate a profit from the upside hedge in the near term to get a much larger profit from our put options in the longer term. And then once we do believe we are near a bottom in equity valuations, that we want to rotate into this set of 5 ETFs initially. Now we can rotate into some tech and in other sectors after these are really fully priced in, but there's quite obvious growth of profits for these sectors coming up. That's healthcare, biotech, medical devices, and e-commerce. Now I'm looking at the Aero Defense ITA ETF as the value play. We just had Buffett dump all of his airliner stocks. And so I do think this will be really pounded to very low levels in the foreseeable future. So this will be our value play. The other group will be either direct beneficiaries of the government stimulus, meaning healthcare, biotech, medical devices. We're likely to pump trillions of government treasury debt into these sectors as a direct handoff from the government. So that's a pretty dead obvious play, but again, not until the market's been repriced. E-commerce is going to grow just from a change in consumer behavior. And then meanwhile, poor Boeing just can't get a break. And so this index, I think, will be your best value play at the right time. So that's what our anticipation is for purchases in the basic portfolio. That's where most of your capital will be deployed. Now, in the pro strategy, we're putting your capital to work in the meanwhile. And so you have between 80 to 90% of your capital invested currently. And if you're following our boot camp, you also have another about 4% invested in a leveraged QQQ put option. The Hong Kong trade's looking better by the minute. We're seeing the Chinese are now not buying any new Hong Kong property, and they're having the worst contraction in their economy in history. So throw in some geopolitical tensions, revoke Hong Kong special status. That's the trade where It's almost impossible to lose anything other than the swap cost. And if they ditch the Hong Kong dollar, because it would cost the Chinese at least $1 trillion to protect it, then this one single trade can double our total net worth with a 1% position. So that's that 100 to 1 potential return. And again, it's almost impossible to lose other than the swap cost. That's 19 cents a day to hold that position. Silver miners are on the verge of going bankrupt. Okay, so the value of spot silver is very attractive. We have a 2-year leap position in the boot camp on this. It is a hold right now. I think we might have a better entry point for new boot camp members. But each of these 3 trades are targeting massive returns with very low risk. So if you're in the boot camp, you have almost all of your capital put to work. So you got to ask, how are we going to put 40% of our account into these beautiful ETFs after the market's crashed? Well, the answer is we're going to be letting go of our TLT call options. We're going to be letting go of almost all of our put options at the right time, and that's going to free up a tremendous amount of capital. Also, we'll be out of USO, so don't worry. As a pro member, you'll be building the same sized position, or at least the right allocation. So 40% of our pro membership is dedicated to US equities. The other 60% we have invested in the bond market, in emerging markets, and or commodities markets. So right now, not a lot of exposure to the emerging markets, and we're really doubled up in commodities between the gold play and the oil play. Now, if you're an old member, you have a handful of positions still open. As Gary pointed out, we have a 23 strike GDX put. So we've actually seen GDX go from 23 to 34 and have bought put option every so often to lock in those profits. Currently, the most recent put option that everyone purchased was the 28 GDX put. And now we're trading at 34. So again, expect me to buy an in-the-money expensive GDX put to lock in those gains and allow us to remain long our shares. Okay, so that's a good overview. These call options are in the money now. We bought these way back in March, so these are relatively in the money except for the 170. Because of the large TLT position and because I intend to move our strikes up in the near future, I have put this on the hold, but don't buy. So that doesn't mean sell if you have these positions, just means hold and expect to sell soon because I do want to move up our strikes and get a lot more leverage in the bond portfolio. How's our returns looking? Well, we're beating Warren Buffett. We're beating Ray Dalio. There's a few hedge funds that probably have made some good returns here, but not many. So considering the markets had 33% volatility, had a surprise shock jump in April, which is the only reason we had drawdown. I think we're doing quite well. I'm quite happy with our return. Now, do I wish I had been watching the Fed's balance sheet with more belief? Yes. So I think we could have had some good hedges in April when we saw them go from 70 billion to up to $600 billion a week. So that was a mistake. I was too focused on the economy being just completely gutted, unemployment at the maximum levels. So that was a miscalculation on my part. Do I think we can go overly bullish from here? No, and the Fed's not growing its balance sheet. In fact, it's quickly reducing the growth of its balance sheet. So I do think our positions are great. And I do want to point out the majority of our drawdown is in that SPY put options. So those give us 2 years to get a massive profit in the range of 500 to 5,000%. Okay, and it's like buying life insurance. It looked like our economy was on the verge of dying when we put that on. The Fed came in and put $2.5 trillion into the balance sheet, literally the week after we put on those puts. So that was unfortunate, but when we look at the grand scheme of things, the duration of your put options, I still believe those will be your highest returning positions, regardless of this April surprise that we had. So we're down 4.3% for 2020. Warren Buffett had $180 billion equity position, lost $50 billion in the first quarter. Okay, we'll look at that, but that's a 27% loss. He dumped all his airliners in April, which he owned 10% of the top four. And now his biggest position by far, without doubt, is his US Treasury position in the bond market. So he has the same, essentially the same strategy we have right now. And he's the greatest enthusiast of buying stocks. In fact, he had a 5-hour shareholder meeting this weekend and went really long-winded into how he loves American companies, bet on America, but only do it if you have a 20 to 30-year time horizon that we might be entering a depressionary era. And he doesn't think airlines will be back to normal within 2 to 4 years. So you've got a lot of the best investors having drawdown this year. We're outperforming them, but still negative at the current time. So that's currently how our returns look. But I do want to point out these put options are going to play out beautifully for us. We have 2 years of time premium. And again, I do anticipate buying more put options in the near future here. Okay, so that's a review of the trading plan. Let me take some quick chat questions before I go into some more content. So Karen says, Fed says they're going to buy the ETFs. So they're going to be able to buy LQD using BlackRock and I believe only fallen angels before a certain time frame, not the entire junk bond market. So that is definitely one thing that somewhat helps the stock market, not directly, as it's again just allowing the corporations to have capital. But if those corporations are laying off and having reduced earnings, it really doesn't support anything other than stock buybacks. Okay, oh yeah, the buy and hold portfolio. Sorry, Julio. Let me cover that. So the buy and hold portfolio has no changes, and I don't anticipate any changes for the next 6 months. The only positions you need to worry about are your VIX put options. So again, plan to sell the 508 on Wednesday, and then quite likely our 515 as well the next Monday or Wednesday. So I'll give you a trade alert on that on timing. But other than that, no changes in the buy and hold portfolio. Buy and hold portfolio has similar drawdown. So you can see it's at negative 5% currently. David has a bonus boot camp trade alert. So yeah, we'll cover that on, I won't be able to cover that in specific detail, David, because most people on this membership level haven't bought the boot camp. But the trade alert's very, very detailed, step by step. So if that's not clear, we can definitely support you on that on Thursday in the boot camp webinar. And also, if you want to email me your trade, I can confirm you did it correctly as well, David. But yeah, you've got it right. Are you using Thinkorswim to do that? Okay, a couple other questions. Jack says, USO, what's going to happen with USO? Here's what's going to happen with USO. So let's talk about the USO position. And this is not, I was predicting this, but now it's not a matter of predicting. This is out in the open. They're openly commenting this, and they're going to potentially add $100 to $200 billion of American infrastructure to store oil, one. And two, they're going to provide a line of credit to investment grade oil companies. So between those two items, that's really what we were hoping for to be long USO. So that's my anticipation. It's currently trading at 19. I'll be looking to exit that probably around $50 to $60. And I'm not going to have a limit order sitting there. So if it spikes higher, I'll be waiting for a catalyst to occur versus a specific price target. So the catalyst is, again, US government bails out the US oil industry. So we can take a look at the future contracts on that and how that really plays out. USO is an oddball product, and they've been changing their investment strategy to make it a safer asset to hold. But yeah, that's basically government's going to bail out the American oil producers, and they've been talking about it. So it's really not a question of how they're thinking about doing it. It's just a question of if and when they will execute their plans that they've been forecasting us. Okay, so Al says, any thoughts on if government comes out with investor-friendly, unique war-type bonds to raise money? Yeah, that war bond is called the TLT, Al. So yeah, they can call it whatever they want, but it's not going to change the TLT. Okay, Jack says, what's your prediction on the Dow? I think we're going to go below the 2008 high on the S&P 500, but not below the 2009 low. And I think it'll end with the Fed having to step in and actually buy stocks. Rick says you expect the SPY to go to 100. Not necessarily, Rick. So that's a very leveraged play. We don't actually have to go to the strike to get a return on a put option. Okay, so in fact, the highest return I've ever seen on a put, the fellow had he had QQQ put options in the 2008 crisis that were anywhere from a penny to 10 cents. It got nowhere near the strike, and he had 10,000% returns. So don't even need to get to that level to have a huge return on that. Jim says he wants to do debit put spreads instead of just long puts. Yeah, so you know, if I were to do that, Jim, I would increase the amount of debit spreads, and then I would move them way higher up if I were doing that strategy. But yeah, same idea, just different way to skin the same cat. So I like our simple put options perfectly fine for this. And again, if we get the direction right with a long put, it's less important if we get the exact size. Okay, Ram just joined in. Nope, Ram, so no changes today except to sell your emerging market put if you had it. That was about a 700% return. Okay, Jack wants to know what's the VIX. So VIX is the volatility index. It's a futures product, and it's a lot like USO and how it reacts and performs. Just to make your life simple, Jack, if the market goes flat, up, or just bobbles around in a tight range, so if we just bobble around on the SPY between the current 280 level and maybe bobble up and down between 280 and 300, you can expect the volatility index to drop and those put options to go up in value. Whereas the QQQ call option, we literally need the QQQ to go up, and we're hoping it'll go way above the 220 strike, and I would sell that at the 230 strike. Okay, DD says, anxious to hear the outcome of the Fed decision last Friday. I couldn't understand any of the top. So they just reduced the treasury purchases from 10 billion a day down to 8. So that's still $40 billion a week just in treasury purchases. We'll see how much mortgage-backed securities they buy. So they are winding down QE, but they haven't cut it off yet. So that could potentially delay the big bond rally as long as they keep doing that. It's also going to delay them being able to actually sell the deficit. So right now, they've really just done an accounting trick to fund the treasury, and they haven't really sold our debt offshore, which is really what we need to do in America here. So they're delaying that while they continue to let everybody sell their old treasuries and clean out their balance sheets. Ron says TLT. So yeah, Ron, the TLT is going to go up when QE gets winded down, comes to the end, and they start selling the debt. So hang on to your, it's no coincidence. Warren Buffett has $110 billion essentially in the TLT, his single largest position. Jack wants to know, yeah, so Jack, put options on the SPY make money if you go down. Every put option you own except the VIX puts are protection on the downside. We did VXX, Tony, not VIX, although they're very similar. So either one will achieve the same goal. Okay, Jay says, what are your thoughts on Bank of America? Is that right? Yeah, so I don't trade individual stocks and really just focus on big macro plays. So I'm afraid I won't have a lot of
It's at Boeing.
Oh, Boeing. Yeah, so Boeing's the largest position in ITA, and yeah, I do want to get that, but again, not till the overall market has crashed by at least 50%. Okay, Murray's upset he has drawdown. So you know what, Murray? The whole world has drawdown in 2020. I can guarantee you, if you were following anyone else, you'd be down 3 to 5 times more than we are right now. So hang in there, buddy. Your put options showing the drawdown have 2 years of time premium. And again, we're outperforming Ray Dalio and Warren Buffett so far in 2020 by a factor of 4 to 1. So they're down somewhere around 20%, and we're down 5%. So yeah, we got caught off guard with the $2.5 trillion pumped into the stock market in April. But again, we have 2 years on our put options, so we're just not really worried about that position right now. Okay, Marlene has a lot larger drawdown than I do. So if you want to email me your trades, Marlene, I can see how you have different performance than I do. Our basic program shows 10% drawdown, but not 18. Yeah, so Marlene, I think that the VIX will go up in value between now and Wednesday. That's why I'm telling everybody expect that to be sold on Wednesday. Support at portfoliobuilder.io. Karen says, should I sell my silver trade and look for a new entry point? You could if you want, Karen, but I haven't issued a sell in the boot camp for everybody already positioned, as I do intend to put that back on at some point. Good question. Oscar says, I think Murray's upset you called us old. Well, I really appreciate everybody, as everyone knows. Okay, great. Let me jump into some of the top news, okay? Okay, so we're gonna go over some top news, keep everybody informed. We'll take a break at the 1 hour mark and then go into a lot more analysis and questions. D says, do you think China would sell US bonds as retaliatory action? Well, they need the whole world needs dollars. So no, I don't think they will. I think we're gonna see more of a Cold War than a hot war in the foreseeable future. Oscar says he likes that bullish. Yeah, so the big news for spot silver is that the silver miners are in big trouble. So there's a supply shock in the silver area. But yeah, the big question is, are the central banks going to stop QE and win? And that's really the best timing on that play. Okay, so let's take a look at the top news. And first of all, let's just go to this data first. Okay, so the real question is, when will the economy be back to normal? When can we get unemployment similar to where we had in 2019? Okay, because that's really the cure for the stock market. You can go take money from your checking account and put it in your savings account all day long, but that's really not going to create productivity or economic output. So to determine when we will get our economy back to normal, we have to think about what caused it to be disrupted in the first place. And so there's a lot of hysteria as to whether the lockdowns were warranted, whether this was, the popular phrase now is a plandemic. Is it a hoax? Was it an accident? Was it on purpose? So these are many of the questions circulating. And so some of the critiques of the data coming out, especially in terms of the mortality count, has been that, and we're seeing doctors say this, they're being forced to say it was due to the plague rather than any other underlying condition. So the guy could have had a heart attack, died, but he was infected by the plague, so they're blaming it on the plague. So that's one critique. On the other side, people are saying there's a bunch of people passing away that are not being counted. So how do you make sense of that? Another group of people like to focus on how many new cases are popping up, although that does put into question how do we go about testing people. And then another group of people are saying, wait, maybe we have already had this. So they're more focused on the antibody test of who's actually been infected. So that does add a lot of confusion to predicting when the economy can get back to normal, as that will be when we want to be buying up equities or around that, keeping that timeline really first and foremost. So I've questioned that myself, going to your local Lowe's wearing the ridiculous mask. Is this really necessary? Is this just a big hoax? And so I've been trying to find data that would really clearly let me know, is this really necessary? Is this just something that's being done to distract the public so they can pass laws, take away civil rights? So let's try to add a little clarity to that. So this has been my best set of data. And this chart's even better to look at. What I want you to look at here is and again, this is from the CDC, so we're still trusting government data, which we know has been at times underreported, at times overreported. At some point in time, they're trying to tell us everything's okay, and then next week they're telling us to panic. What's the reality here? So this is the excess deaths data. The orange line's your average, and then the blue is your actuality. And so the trend is every winter we have a spike in excess deaths, and then it comes back down all year, and then it spikes back up, comes back down. Now, what happened this time around? During the period when the death count should have been dropping like a rock seasonally, we had this spike to all-time highs. Okay, well, that's at least US data. What about world data? So in Europe, we have this website that's tracking 24 different countries. So has a good look at all of Europe. And same thing, look, we have the same trend. And right when the deaths should have been reducing, we had this huge spike to the upside. And then what made it come back down? Well, worldwide lockdowns. So that makes it quite clear that at least if we trust these two pieces of data, that the lockdowns were warranted, and had they not been issued, this would be going out of control. So I do believe that we can say the lockdowns were warranted and did provide value. So the next question is, well, okay, are we going to be in lockdowns in the foreseeable future? And if so, for how long? So the solution to this plague is either a vaccine or herd immunity. Now we have the administration pumping up that we may have 100 million vaccines by January of 2021. Which is interesting. Now there's 7.5 billion people. So is this just for the United States? And is it really possible? I would argue that no, it's not possible nor safe, but I do keep an open mind. And again, want to also play the news. And also, of course, we got to pay close attention to what the central banks are doing. So in my modeling, we've updated this. We're saying we need to hit 50% herd immunity. So 3.7 billion people will be infected to hit herd immunity. Of that group, 9 out of 10 showed no symptoms. So only 1 out of 10 will actually get sick. I do believe that's accurate. although we could modify that to be even less if we got data to support this. So I'll keep it at 1 out of 10 gets sick for now. Of the 10% who do get sick, we're estimating 20% will need ICU, some sort of advanced medical treatment at a hospital. So that brings our target of hospital cases to 75 million people. Now, unfortunately, we're not able to actually save many of the people who are getting sick. Right now, that's about 1 out of 10 that get to a low oxygen level. Now, assuming that does get better, I've put 80% in there. So this leads me to believe that we would not reach herd immunity until we've had 60 million deaths. Now, that's probably not something governments are going to allow to happen, which does make me believe we will be in and out of lockdowns anytime we see the spread start to spike again. Now, if you follow the news and look at data from mobile data, people are out and about. They are not practicing social distancing, and give it another month or two. And I highly doubt you'll see Americans wearing in majority masks or anything of that nature. So we'll have to keep a close eye on it. But at this point, I do expect in and out lockdowns for the foreseeable future until there's a vaccine, and that it won't be realistic for the medical system to host 60 to 75 million people, nor for any government to allow this many casualties. So their only solution is one that really destroys your economy. What about in the US specifically? 350 million population. Same herd immunity, 50%. Same 10% get sick. The other 90% don't even know they had it. They're just spreading it. 20% need ICU, 80% death rate. We need 2.8 million deaths in America to really think that the population's had herd immunity or a vaccine. So the short-term outlook is that without lockdowns, this will spread rapidly and cause future lockdowns. So I don't think we can really predict that our employment numbers will be back to 2019 levels anytime soon. And thus, we can't count on consumer spending to be at that level anytime soon, which is 70% of our economy. Okay, so where do I expect the antibody tests to prove? Well, in New York, in certain little tiny little counties, they're getting readings in the 15 to 20% range. Other parts of New York, they're finding people with less than 5%. So I do believe this is quite accurate, that around 2 to 3% of the US total population has had this and developed antibodies, and that the other 97% of the population is currently at risk. So that does mean if you do release or at least relieve the constrictions on mobilization of your consumers and your populace, that this will begin to grow rapidly and cause more pain. Furthermore, we really don't have capacity for 3.5 million ICU beds. We had something like 100,000, of which 10,000 were available when this whole crisis began. So we have nowhere near the capacity to service this many sick patients in the US. So really the maximum we can allow in terms of social distancing to be relaxed is the minute your hospital system becomes overwhelmed. So a lot of people are saying, wait, we didn't have an overwhelmed hospital system. So we didn't even need to do all this. But really, if you look at New York, you can see what would potentially happen without the lockdown. So we'd made the same mistake in 1917 with the Spanish flu, and we're right on track to make that same mistake this time. Now, we'll see just how much precautions Americans take and other developed nations to slow down the spread. It's a tough battle. In one basket, you ruin your economy, and that has many negative effects in itself, including increased death. On the other hand, you let people do whatever they want, and you're going to end up with a lot of sick people overflowing your hospital system. So that's really my main concern about the U.S. economy getting back to normal and having a rebound. So unfortunately, there's really very little data to lead me to believe that we're anywhere near herd immunity, and everybody's hoping now, they're doing this Operation Warp Speed for a vaccine in January to get 100,000 vaccines ready. But really doesn't matter for short-term predictions in terms of what's going to happen in the bond and stock market. So we'll take a look at that in a minute. Really quickly, you can see the US death count flatlining. That's good. Same with the world data. But again, that was only accomplished with over a month of lockdowns. So what's going to happen when you reopen your economy and reduce all the fear in the media? Well, it's going to come right back. Okay, so Italy, Spain, Germany, United Kingdom, all in the same boat, doing the exact same things. Japan's waited a long time. They're hoping they could pull off the Olympics this summer. Hit everything. Now it's deep in their society, and we're starting to see this grow exponentially. Singapore was quite brave early on, thinking they had it under control. Remember, everybody's hoping that Singapore would be the case that hot weather would slow the spread. Well, they're growing at an exponential rate, and their temperature never goes below 80, and they have really the most advanced society on the planet. Really, some really cool things they've done in Singapore. China is now showing cases come back, which is interesting. I look at China's data more as propaganda. South Korea's had the most extreme restrictions, and those did work. But what will be the impact on their economy? India. Now I look at some of these poorer countries. Unless we intend to essentially quarantine some of the larger, poorer populations from the rest of the world, there's really no chance we stop this in its so I look at India, which again is too poor to test anyone outside of really the wealthy. Exponential growth in new cases. Indonesia, again, all these countries can't afford to do lockdowns. Otherwise, their population would starve. They have no savings. They have no ammo in their central banks. They have no credit in the world. So Pakistan, Brazil, Nigeria, Russia is actually having rapid exponential growth, and of course Mexico now. Also in a local town in my state is in a complete quarantine right now in New Mexico. I think it's a highly populated Native American population. The whole little county's currently being quarantined right now. So bottom line is the cause that's going to slow our economy is nowhere near fixed, and that does help us with timelines. Okay, at this point, I'm going to take a quick break for Dean to review our product options, and then we'll go back into more detailed analysis and Q&A.
All right, Jason, thank you. Folks, thank you very much once again for your time. And just real quick, let me go ahead and post the links to the chat box here, just in case you just joined us, you wouldn't see that link. Just give me 1 second, I'm going to post that in there, and then we'll review them real quick. So once you click on the link that is in the chat box, folks, it's going to bring you over to this page, the page that you're looking at your screen, okay? And it shows the options that are available to you, okay? Now, if you want to get the most interaction from us, just completely possible. And if you want to go from whatever level of trading you're at to a pro trader, the boot camp for life is phenomenal. Okay, so that's at the very bottom of the screen in the right-hand corner there. Okay, we're literally going to teach you guys how the financial system works. We're going to teach you about the best trades that are out there. Okay, the highest risk to reward trades that we see. All right, and also just really teach you options inside out, backwards, forwards, upside down, sideways, And so basically how to utilize those options during different strategies, okay? And so really kind of in-depth, hands-on boot camp that's available free for life for just shy of 10K. It's not going to be like the 20K boot camps that you go to for a week that, you know, nothing's recorded, you know, and hopefully you take some notes and, you know, you go back to your house and you spent your 20K and there's nothing to look back on. All of the education in the boot camp will actually be recorded and archived in the membership area. Really cool to be able to go back and access that. And my favorite thing that comes out of the boot camp is absolutely the Tuesday content emails and also the trade alerts, because they've been extremely profitable for me. So I appreciate that, Jason, and thank you for all the content you produce in the boot camp. It's phenomenal. Module number 1, I've certainly watched 5 times now at this point, just to kind of get a feel for history. The Pro Portfolio, guys, is great for anyone that has a minimum of 75,000 in capital, okay, or much, much more. All right. That's what I'm personally using. Most of our clients that have, you know, kind of between a couple $100,000 and a couple $1 million in the market, they're using that portfolio. Okay. The basic option portfolio, all right, is good if you have between 30 and 75K to invest. All right. It's currently just trading options. And we're showing you guys how to basically short the market long-term. All right. And we'll tell you when to go back in and buy the market. But basically, for now, you're just going to trade options in the basic portfolio. Okay. So that's going to have the highest risk to reward is going to be the basic program. The buy and hold portfolio is super simple, folks. All we do is go long or short specific asset classes with ETFs or inverse ETFs. Very minimal changes made to the portfolios. All right. And great for anyone that has less than 30,000 in capital. All right. And so if anyone has any questions about how those all work and why, please feel free to go ahead and unmute your microphone. We'll take a couple minutes to chat about that real quick. And then the really cool thing too, guys, if you upgrade to Pro or Basic today, you will get 30 days of boot camp for free. All right. And if you're an existing member, depending on when you joined, there may be an option for a lifetime membership of both the boot camp and the portfolio trades. So just give me a call. It will depend when you signed up, depend on the price point you have. But would love to help you all with anything we can, any questions that we can answer to help you and your family grow your capital in the safest manner possible. Please feel free to reach out with those questions. And so to get to this page, guys, once again, simply click the link that's in the chat box. That will take you directly over to that page and let you all sign up for the program. And we look forward to working with you. Thank you so much, Jason. And I think we should be good at that. And I got a call. I got to hop on in just a second. So any last questions, guys, please feel free to reach out. Happy to cover those.
Okay, wonderful. Thank you, Dean. Okay, great. I'm going to continue and get through the rest of my content, and then we can do some out loud questions towards the end here as well. Let's see, quick questions I see coming in. Abby says, please stop the conspiracy theories. Okay. So Abby, I do want to point out we were one of the few to predict the first leg down in the stock market, and it was completely because of focusing on what's happening with the plague. So I'd say I've been quite accurate on that front. Okay, Kareem says, I heard China is going to sell treasuries. Will that affect our call options? I don't think China will sell its treasuries because it needs dollars to operate its economy. So it's already low on dollars at this point. Jack says, why did we buy a QQQ call option? That's a upside hedge in the short term. Jack says Taiwan and Vietnam are the best tackling the pandemic. Taiwan sure did a good job. Of course, they hate the overreaching of the Communist Party and had spies over there. So they did see this coming way early. And yeah, they did a great job. Okay, great. So let's go ahead. If you have any more questions, guys, keep posting those. I have a lot of content I do want to get through. So I'll do a quick review of the trading plan once again. These trades, as Jack continues to ask, are hedges against the overall strategy. So these will profit if the market goes flat or up. Okay, so I do think there's a risk the market can go flat or up through this period of time. So that's why we have those. Okay, they represent a much smaller piece of our total strategy. Larger investment includes our SPY puts in combination with our TLT position. So TLT goes up when stocks go down, just in general. So that's the big picture here. So the big picture is we're betting on a massive crash. We have lots of put options, and our risk is that in the short term, the market can go flat or up. So we have hedges to protect against that, Jack. If you're in the pro membership, you should again have the basic trades plus the pro trades. The bulk of our capital is playing the TLT, the same position, which is the single largest in Warren Buffett's massive Berkshire Hathaway. Okay, same position JP Morgan has most of its assets. The same position the big central banks have most of their assets. Okay, it's all in the large bond market, the long end of the the 30-year treasury is really the most leveraged product in the treasuries for our positioning. USO is again a bullish upside short-term bet. Okay, I believe the American government is going to bail out energy, specifically oil companies in the US. Okay, so that's a quick hit. One last bullish thing I want to get out of the way before I add even more put options. GDX is very, very correlated to the S&P 500. In fact, it's been outperforming the S&P 500. And so this is another hedge against upside risk, but it does have a longer term outlook than USO. So I'll take a look at our strategy for gold in a moment. The call options and put options on the TLT have two different purposes. The put option protects downside risk on the treasury market. So if there was a short-term sell-off in treasuries that caused the value of this to go down, then we still get the minimum of 161 per share because we have this cheap put option. So that's really a very unexpected move, but we have that protection. Mark, yeah, I don't have those handy, but we have covered that every time there's a piece of information out, so I'll keep an eye on it. But yeah, the Treasury Secretary has been mentioning the $100 to $200 billion in, or rather 100 to 200 million barrel storage facility, as well as creating a lending facility for institution grade. So yeah, I'll look for that quote if we happen to see it, but that was news last week that we did put on the webinar. Eric's got a note from Ameritrade about some oddball pairs. No, that has nothing to do with our position, Eric. Jack says, why are we buying the put option so far away? Yeah, so I want the government to bail out USO, one, and then to sell the ETF, and or rather the ETN, and then hold the put option longer. So timing's difficult, Jack. So we bought a put option with plenty of time to realize our goal, which is a spike in the value of USO. Okay, so we also have the GDX put. Again, that's at the 28 strike. You also had a 23 strike. We've been following GDX for quite some time. It's currently trading much higher. And again, that means we've paid off the cost of our put. We have not sold those puts. And I do plan to buy an in the money put option in the near future. That means the put option will be above the trading price. Okay, so that'll quite likely happen at the same time that we add a new SPY put. And Karen bought the cheaper put option expiring October. So if you want to stray from the trading plan, you can, Jack. Just realize I'm not going to be able to keep track of everybody's different positions. So you'll have to notify me on the chat if you have a different position, and I can give you some insights. The USO put, again, this protects you in case USO goes to zero. If you did nothing other than hold the position to January 15th, you would get the $20 per share, even though it's only worth 19 currently. Then you would lose the cost of your put option. So against the married put strategy, and there's really three outcomes we can expect. Either USO goes to zero, highly unlikely at this point. You'd need the 4 months ahead in the futures contracts to go negative. Don't think that will happen. Could it be pushed lower? Sure. If USO goes much lower, I'll be tempted to sell that put for a profit and then remain long my shares. If it goes bankrupt again, we just get to exercise our put. If it kind of just trades around at this level all the way to January 15th, we just allow the option to expire and to exit the position on January 15th. So that's why we bought that put. Now, if USO spikes in the next few weeks because the government bails out oil, I will hold my put and just sell those shares and look for a better time to sell the put. So I do think we could see a spike in USO, sell the underlying, and then long-term outlook for oil still remains very, very poor. FXI is a bet against China. Expect to buy a 2-year leap to add to this position, as I do think things could be worse after the election versus before the election. So this is highly correlated to the S&P 500 for a short-term sell-off, but I will be looking at, again, a multi-year leap option on this same position in the near future. Jack says, why do I think the U.S. government's going to save oil companies? Well, they said they would, Jack, so there you go, straight out of the horse's mouth. Between 5 to 15% of your position, again, is currently in your basic portfolio allocated, and you're standing by to buy these companies, which will be direct beneficiaries of the government bailout, healthcare, biotech, medical device. E-commerce is benefiting from a change in consumer behavior, and then the primarily Boeing's just getting eaten alive here. So I think that'll be a good value play once we do get to much lower valuations in stocks. If you're in the pro system, again, we've put almost all of your money to work. The biggest positions in the TLT, the same position Warren Buffett has, the same position JP Morgan has with the bulk of their capital. So we'll look at the analysis of that in a moment. If you're in any of our old positions, USO members got in at different strikes before the split. Those are still a hold. You shouldn't be adding that new USO if you're already protected. The GDX put we've paid off many times over with the rally in GDX. So the put option served its purpose. I'm waiting to sell that in case we get any volatility in the coming weeks, although it may expire worthless. And again, I do intend to buy a in the money put option on GDX because I do not think it will continue to rally and will sell off at a faster pace than the S&P 500. The 3 TLT call options are a hold. Don't buy today. We will be selling these soon and then moving the strikes much higher. Okay, so let's jump into some new content now. So we'll start off with the Twitter content. And yeah, Jack, hopefully we'll see it. But yeah, the Treasury Secretary said 2 things. One, they're looking at creating a storage facility to host 100 to 200 billion barrels of oil, which is really what caused the crash in WTI in the first place, a lack of storage. And then 2, to extend a line of credit to the oil industry, at least the investment grade oil companies. Okay, so that's the two catalysts that they've literally told us from the Treasury Secretary already. So it's just waiting for that to occur, and then I think we'll get the spike in USO. And that's really the last thing I see before I want to add the next level of SPY puts. Okay, so let's take a look at the content I have highlighted in Twitter. And again, you can follow this at Generates Income. Okay, economic activity has probably bottomed, says Goldman. In China, activity has rebounded quickly since February, despite only a gradual decline in lockdowns. If the West manages only a very partial repeat of that performance, that would imply brisk sequential activity growth. So I do want to point out what China did is far different than what the US did in terms of their lockdowns, and as well as what they're doing when reopening. So they literally were welding people into apartment complexes, quarantining major cities. We have footage of people trying to rampage cars through blockades. We have drone, there's people getting hung if they wouldn't wear a mask outside. If they had extremely strict protocols. You had to have a little note to leave your house. Only one person in the house could leave every several days. So they took the lockdown far more serious than we did. Also, while misreporting the human-to-human infection, they went and bought up all of the PPE around the world. So now we can't even get masks to have a similar strategy as China. So I highly doubt that our reopening will be nearly as successful as China's in that regard. China warns of possible armed conflict with the US over the backlash. So we're seeing the rhetoric between the two nations get more aggressive. Elon Musk put two of his homes on the market after tweeting he would sell most of his physical possessions. Buffett's shareholder speech had a great analogy to what's going on with all of this. And he says, if you bought a farm and you thought it was going to produce a certain amount of eggs or whatever produce per year, and the farmer was just crazily changing what he wanted to sell his farm for. At one moment it's 2,000, the next day it's 1,200, and then it's 1,400. Did the farm really change its value? Probably not. So he really looks at businesses based on the income and profits they can generate, and not necessarily what a small group of people in the short term want to buy or sell at. So that was his long-winded explanation that the airline industry probably won't be back to where it was for years to come, and that's why he exited his massive position in the airliners. Now, 90% of all assets are controlled by a tiny group of the population. And so it's this tiny group that, at their whim, that can create the short-term valuation of assets. And so we can see this group of super rich starting to get scared. And so with Elon Musk selling his houses, Warren Buffett having a bigger position in treasuries than anything else, and he's your biggest, he spent 2 hours talking about why equities are better than treasuries in the beginning of his shareholder meeting. And then threw up a slide showing his single biggest position is in US treasuries at $111 billion. So everybody's saying one thing, but doing another. And he was just saying, if you bet on America for 20, 30, 40, 50 years, you're going to do great. But in the short term, we might be heading towards something like a Great Depression. So it was pretty interesting shareholder meeting this time around. Okay, one thing to watch is the USD CNH. So we are seeing China begin to devalue their currency. It's near that 7.2 level right now. If it goes beyond that, that's been a very good leading indicator to stock crashes. They only do this when there are tariffs, and that helps offset the impact of tariffs for their exports to US. And so Trump's been threatening tariffs all weekend and all week. And also, I do want to point out, Buffett with his $110 billion in cash did not buy the dip in March. He sold his airliners in April, so he's not expecting this to be the bottom based on his activity. Stephen Henrik, he had an announcement. He's not going to give away his free weekend video anymore unless you subscribe. I've been watching him for quite some time. He's a good guy. He's more of a bear overall. Rick says, how do you buy U.S. Treasury? TLT, my friend, TLT. He's probably got a variety of expirations, durations. But yeah, the TLT is the best one because it's the 30-year Treasury. So it has the highest yield and the most leverage with what we're expecting. Okay, Stephen Henrik says, you know why the Fed had to blow $2.5 trillion into their balance sheet to halt the decline? Because they didn't have 500 basis points and rate cuts to play with. The Fed is shooting blanks. The stimulus effect from rate cuts is much smaller this time around. Okay, now that everybody thinks the Fed cancels every bear market after a few weeks, perhaps a couple of reminders of how the real world works. So he's just showing the 2002, or rather the dot-com bubble here. So lots of dead cat bounces all the way for a 2-year crash on that chart in the 2007, 2009. Again, it took a year to get to the bottom. And again, the losses to the economy of both of those crises were at least 1/10 of what the world's facing right now, if not 1/100th. So it's really hard to grasp just how massive what's happened to our economy. Jim's asking if he should add to his position. No, I would keep the same ratios, Jim. Now, if you're adding a whole nother block of $1,000, you could add to it. But other than that, I haven't issued an increased relative position on that one. So if we go back to the trailer, just make sure you have the same ratios. And Rick says TLT all calls, I assume. I'm not following what that question, what you're actually asking there, Rick. So yeah, he's buying the real treasury product, but those are sold in lots of $1 million. So we're buying the TLT, so we don't have to put up $1 million per bond. So yeah, TLT's for retail to buy, and some big hedge funds do that. But yeah, and there is a different ETF for each different type of bond, but you get the most leverage and the most reward for what we're predicting with the TLT by far. Okay, Treasury Secretary expects China to make good on its trade agreement. There will be very significant consequences if they don't. So far, they're falling short. And remember, there's a exit clause in the trade one deal. Yep, that's still a hold, Rick. You're right. Yep, if it says hold, that means a hold. And so you're correct. Mark wants to know how the TLT, it's based on the yield. So if the yield goes up and down, the treasury goes up and down. Just like supply and demand of a bond is how that works. Okay. So we're starting to see the writing on the wall that China's not going to live up to its trade deal. They had an exit clause in the trade one deal, which said if there's a pandemic that they don't have to make good on their agreement. So funny, they knew there was a pandemic back in November, December when they signed this. How ridiculous is that? Okay, so Spot Gamma likes to study where there's a lot of option trading, and Nomura is really an expert at predicting buying and selling based on a change of price or a volatility change. And so they're both really agreeing that if we pop above 290, you could get a bunch of automated buying. And if we go below that, you could get a bunch of automated selling. So my expectation is there's a risk of us just bouncing around between that range for quite a while. That's why we have our VIX put options in that position. And we'll continue to have that on a weekly basis. So that VIX position this week isn't paid off so far, but as you know, we were up considerably the first day we put that on. It's just the disappointment from Apple and Amazon that really went against us for this first expiring put. Now this is very bullish for equity markets, and or at least could be. Fed says it will start buying really LQD primarily in early May. So that's going to allow a lot of big companies to continue doing stock buybacks if they choose to, and to grow their debt. Now, the more debt you have, the more that drags on your profits. So in general, that's not a good thing. Ian asks, when will the 5 ETFs be purchased? I'm thinking it'll be around November at this point. I think we'll see a short-term low around November or December, based on my modeling. But a lot of that depends on how aggressive we get against China, and as well as when a vaccine's actually working, as well as what the governments decide to do with either letting the plague just rip through society and just deal with it as best as they can, or are they going to be in and out of lockdowns for years to come. So timeline is difficult, but I think at least a 50% correction before I'd even consider buying ETFs that are of that group. So my expectation is we're going to see we know the current president is not liked by a lot of very, very wealthy, powerful people, which you can see in the media. And so those same powerful people quite likely will be doing everything in their power to get him out of office. So I do think this is going to be a very nasty election, and that you'll also see equities crashing into November due to that. There's a lot of very powerful people who do not want to disrupt the relationship with China. Okay. And so that's really what's at risk with the policies that have been put in place over the last several years. One of which is Bloomberg. So John says, should we sell and close the puts or still hold? So yeah, I put a timeline on that, John, in the email, which is the first one I intend to sell this Wednesday. Karen throws out, and ruin our country, no conspiracy theory here. Yeah. Yeah, so you really have a group of people who don't want to be loyal to a given country. They want to be form a more of a world order of some sort. Okay, William's asking. Okay, let me go back to the trade alert so we can look at what it said. Okay, so I wrote we will sell the 5.8 VIX put on 5.6 this Wednesday. The other VIX I will sell one per week. Okay, so again, we want to hold these until the week of expiration and probably sell on either a Wednesday or a Monday. This position right here, Rick. The May 32 puts, which ETF are you talking about, William? Oh, you're talking about this one. Yeah, we're going to sell one of these a week, the week of expiration, and I will continue to ensure we have one of these leveraged VIX puts until I'm quite confident we're nearing a crash. Bill says, why do you have June, September? Yeah, timelines changed, Bill. So timeline has been changing a bit. I was initially thinking that we would do a longer lockdown, which would potentially give us more of a room to reopen the economy and more time to get, in masks and testing appropriately in place. But now they're trying to rush the opening. They did a half-assed lockdown. We don't have the testing in place. So I think this is going to extend the crash, unfortunately. So I was actually anticipating that we would do a longer lockdown than we did, and that we would reopen with much better protocols. So what we're doing currently is absolutely going to be a disaster. So I do think that's going to potentially give us a bottom around November. So yeah, we will have to keep that in mind with our positioning. Yeah, so I'll be playing it careful in terms of when we buy that. Jay says TLT a buy. Yeah, TLT is going to be a long-term buy and hold. Bill says, why buy those puts now if you haven't already? Right, I think they'll be highly profitable, Bill, and that's why I'm telling people to buy them right now. And again, we do have people coming in every day that are new, so I have to keep them positioned. And it does make my job a little difficult because we got to realize people are joining at different periods of time. They're getting different prices. So I'm trying to not cause existing members to be rearranging positions unnecessarily, and to allow new members to get into positions that I think will be highly profitable. So sometimes that'll work out in older members' favor with timing. Sometimes newer folks will have the benefit of better timing as well. So that's, the thing I missed, the biggest critique of myself was missing that the $2.5 trillion added in right after we bought those puts. They came in with $2.5 trillion in stimulus at the Fed's balance sheet. And I should have played that better. So I do apologize for that. But in the long run, again, we've changed very little. Very little in our portfolios changed. So I'm highly confident we have a lot of time premium on all of these positions. And the last thing I want to do is reverse our strategy at the very worst time when the Fed's reducing QE. So I think, unfortunately, there's no change to be made, really. We just want to stay strong and look at the big picture. And we'll look at the big picture in a minute here. William says, if all the VIX puts expire at 0, where will we make up the drawdown? The VIX, okay, so every put option in your portfolio and the TLT is one in which will go up if the market goes down, just in general, William. So about 60 to 70% of your portfolio's position for a down move, and you have 4% at risk of an upside move with those QQQ calls. So we're much more designed for a massive stock market crash than we are for those VIX positions. Okay, let me go ahead and go back to content. Okay, Hong Kong records worst contraction in history. U.S. Secretary of State has seen all the classified information gathered by the best intelligence network in the world on the origin of the plague, the cover-up, the hoarding, the disinformation campaign. Okay, so we predicted this, I think, in early February, that this was going to turn into a war between U.S. and China. And so that prediction is playing out. Mexico is experiencing very big plague problems, and now California gets this, doesn't want people coming over the border. A classic. He's just bragging about his wall. Yields jump after Apple announces another massive 4-tranche buyback. Okay, so they're going to borrow $50 billion to buy back their own stock, which is about 5% of their market cap. So some good news, I guess, in this very, very short term if you want to get out of Apple at a high price, but not enough to protect Apple. New York Fed responds to Jeffrey Gundlach, reveals it will start buying ETFs in early May. Okay, again, this is going to allow corporations to do some more buybacks potentially. it's not going to force them to keep people employed. It's not going to force them to do CAPEX investing. And they may decide that they don't want to do corporate buybacks. They want to just try to survive. So we'll see what exactly these corporations do with all the bonds they're going to issue. But at the end of the day, it does not fix the real problem in the economy. US manufacturers' new orders crashed by the most ever, and April will be worse. Crude storms above 20 on far smaller cushion build. Okay, so this is a great look on the different prices of oil, depending on which month you're looking at. And USO is one where we want the short-term outlook to pop in terms of what the value of oil is and to go above the long-term outlook. So with the Saudis just trying to really bankrupt all of their competitors in Brent, and then we have, so that's the long-term pressure on oil is what the Saudis are doing. The short-term pump on WTI, the American measurement of oil, is where we want the supply to increase in terms of storage. So storage capacity increase would make the value spike. That's why it went negative, as they ran out of storage capacity. And then at the same time, to give a line of credit to the investment grade oil companies, which could potentially allow them to reduce how much they are digging out of the ground. So you get those two at the same time, and that's what I'm expecting to spike USO. So I really like that trade. And again, we're trying to get around 100% return on the underlying and then remain long the put, as this big picture is the global economy is going to be at a very troublesome spot for the foreseeable future. So I think long-term, this is a short fix and not a long-term fix. And again, the only real fix is get everybody back to work. So until we can confidently say we're not going to be scared to be within 6 feet of one another without masks, it's impossible to get the economy back to where it was. A vaccine by the end of the year would be a shocker. So SARS is the most similar to this, and 2002, 2003, these scientists have been studying it for nearly 2 decades now, playing with it, manipulating it, trying to make vaccines for it. No luck. They made one. It created antibodies on a mouse. They gave the mouse the SARS again, and its immune system killed it. Okay, and I don't think they've done a lot of testing on that. So just because the vaccine makes antibodies doesn't mean it'll actually fix anything. Saras says, yeah, Saras, go double check the trade alert. Okay, so I did mention when we will sell the 5.8, and we're going to sell those the week of expiration every week, just to be really clear. But trade alert does, I have commented on that a few times now, so hopefully that's clear. But yeah, you're going to sell one per week, and I will continue to have one of those in our portfolio until I see some leading indicators that make me believe we're at the verge of the crisis. CNH getting very close to a key level. Okay, so you can see the last time the trade war was escalating back in August, we got to the same level. And we're nearing that same point. So the Chinese like to devalue their currency when they think there's tariffs or if there are tariffs. We're playing that same basic trade with the Hong Kong trade in the bonus program. Now we could also trade CNH with the futures market at Interactive Brokers, but I'd want to actually see real tariffs and not threats of tariffs to put that play on. CNH isn't worth a squirt of toilet paper going to double digits. CCP was running a fiscal deficit of -12 GDP before they infected the world. Can you imagine the real exchange rate? Yeah, so they have strict capital controls, lots of manipulation on that currency. China made a mistake initially. We never wanted to cover this up. Hubei dismissed main officials, but the bigger mistake made by the US government are still being covered up. Yeah, so clearly their top team was actually the ones telling these officials not to do stuff. So to fire the Hubei province officials as a joke because they had their hands tied by the top leaders. Imagine a casino where whenever the high rollers lose all their chips at the poker table, the casino just gives them new chips for free. That's the Fed now. Nobody gets to fail. Nobody gets to lose. The high rollers, that is. So the thing is, I think that was just a temporary thing here. Rick says, can you expand on your strategy for all the SPY puts? Jack, yeah, so I think I've answered the strategy with the VIX puts and how they work in the portfolio. So Rick says, can you expand on your strategy for the SPY puts? I'm getting ready to enter. Yeah, so we're going to wait for the market to sell off and then slowly but surely sell those put options is the game plan there. And at some point, layer into a group of ETFs, which are those 5 that we've pointed out. And expect one additional SPY put probably within the next 14 days. That'll be a much more expensive put. So expect one more SPY put coming into the trading plan outside of those out of the money puts. Between 40 and 50 million jobs at risk in the Eurozone. So Europe's really getting hit hard by this. And watching the euro currency is another good heads up that things are not right. Major currency pairs against the dollar are all really faltering. So if you're worried about the value of the dollar, I'm not. I think the dollar is going to be very strong for the foreseeable future due to this. Which is another reason you got to be careful with anybody investing in digital currencies, gold or silver. At this point in time, it's not conducive to a strong dollar. Central bank policies can disguise risk but not eliminate it. Only in the first quarter of 2020, 149 billion in investment grade debt has been reclassified as junk. This is excluding emerging markets, by the way. So we're starting to see different bond issuance being re-rated lower. Same thing that we saw in the 2008 crisis is what he's pointing out. Emerging market collapse. Emerging economies are losing around 1.5 billion in reserves per day. Okay, so that's one main reason people aren't selling treasuries is because they need dollars to buy everything. Everything's denominated in dollars and they're running out of them. Mike K says, why SPY puts rather than the QQQ? They're highly correlated, Mike. So, but the boot camp does have a QQQ put. The one thing most people should take away from bus. In my view, for most people, the best thing to do is owning the S&P 500 index. It's a good, in your boot camp update Tuesday, I will be giving you a link to Buffett's shareholder video, which was very good. So I do recommend everybody watch that. Rick's asking what the cost is on the, yeah, that does sound right, Rick. Stephen Henrik, there are now 2 kinds of people, masked people and unmasked people. It'd be interesting to see what happens in the next month or 2. Are people going to keep playing it safe, or is everyone going to think this was a big hoax and remove the masks and stop the social distancing? People are going crazy trying to stay apart, not see their family. Japanese panel recommends state of emergency extension till May 31st. Massachusetts Walmart ravaged by plague, 21% of employees infected, store closed. Okay, so Walmart and Amazon both are having trouble with labor. So these are two companies I expected to really be shining out of quarter one, and they're having issues. Now, the entire restaurant industry is really in trouble. They barely can make a profit with their restaurants packed, much less if they have to reduce capacity by 50 to 75%. And surprisingly, a huge percentage of the population works in restaurants and things of that nature. So there's going to be a lot of people without a job. Trump keeps talking about how Dr. Fauci and the intelligence agencies were saying to ignore the risks, and that he ignored their advice by banning travel from China. So it's interesting. Was he manipulated to try to make this go more full scale? An interesting hint at that is we're seeing the media really pump up remdesivir, which is extremely expensive. I think it's about $1,000 a pill. And the data just really doesn't suggest that it's all that useful. Now, there's a group of people I've been listening to called the Scientists Against the Plague. And again, I flip out that word for censorship issues, but they were thinking that maybe remdesivir given at something like 10 times the dose much earlier on could have some benefits. But the data for hydroxychloroquine could be better, and it costs $1 a pill. And so when I see him pump that up in his interview, which was Sunday, I believe, he's still pumping up hydroxychloroquine. Now, Gilead, the owners of remdesivir, really control something like 8 out of 12 seats on all these different government panels that are making all these recommendations and really manipulating the FDA. So to see them rush out the approval at the FDA seems like just a way for that specific company to benefit, even though it's really not going to help anything from the data I've seen. So not quite sure who the dirty players are here, but I would do have reason to believe that there's plenty of what you could call traitorous people in the United States that are not necessarily have the best interest of American citizens. So I'm trying to really deep dive into where that conflict is to help predict the future here. Okay, Trump's first he was saying there's not a single death. Now it's going to be less than 10,000. Then it's less than 50,000. Now it's less than 100,000. Unfortunately, I think unless we get a vaccine, I think it's going to be closer to 1 million, or we're in and out of lockdowns until there's a vaccine. So that's really sad, but unfortunately, when I would think we're getting near an end and having herd immunity based on my data, or we just kill the economy, which is not really a solution either. So, okay. Okay, so they're hyping up a vaccine by the end of the year. Not only couldn't we create one for 17 years for what this is highly similar to, SARS-1, the safe process of testing this, making sure it works, doing trials, phase 1, phase 2, phase 3, phase 4, takes, we'd be lucky to have this in 2 years, much less in 7 months. Berkshire has been selling stocks and stockpiling, not cash, but treasuries. If Buffett isn't seeing opportunities in his own stock, what are we to think about the recent sell-off? Okay, so yeah, you got your greatest buy and hold advocate in history, extremely smart, and he's selling, not buying. Okay, so that's these news clips. I'm gonna flip through. Okay, so here's some interesting data. Again, all these links are in your webinar doc daily. So I gave you what I was able to. I have a lot of new content, which I'll provide tomorrow for bootcamp. But Monday, Wednesday, Thursday, Friday, in the webinar teaser email, there's a document to all the links I'm going to cover so that you can go deep dive into the same materials. And Jack wants to know what QE is and how it affects stock market. Yep, I'll cover that when we get to those slides. Absolutely, Jack. So right now we're finishing up the news, and then we can go through the economy and the stocks and bond market, gold market, all that good stuff. Okay, so mobility trends. This is a good way to see economic output. We can see Americans are just not happy with having their ability to socialize restricted, and we're seeing they are not responding well to this. UK is starting to spike up, but we're still nowhere near where we were at. I do believe this is going to cause a spike in infections and mortalities in the near future, unfortunately. So they've got a lot of good data to indirectly get a good idea of whether the economy is back to normal levels based on this. I'm going to scroll down. Grocery stores was interesting. You see this huge spike, and now it's back to normal. So just kind of hoarding goods. May is also supposed to be a month where we could see a lot of supply chains break down and food inflation prices, because a lot of big meat producers went into a temporary lockdown. Now they're having a hard time getting anybody to go back to work. But the restaurant business is one I did want to point out. Let's see where that one is. Okay, liquor stores. Okay, there's your dining, just down to almost zero. That's a big part of the economy right there. So there's a lot of bankruptcies, a lot of pressure in real estate just from this single chart that can create a waterfall moment of selling. Okay, this is a link you have access to. Interview with Trump, talking about vaccines, talking about tariffs, talking about hydroxychloroquine is something I did have a lot of interest in, because there's a clear move by a lot of powerful people to try to pump up that remdesivir, even though it really, you have to give it to 30 people to save one with the data I have, and that would cost something like $30,000 to save one person, maybe. And that data is not even. Jack, if you want to hedge property value, follow our trading plan. I am predicting a big crash, and most of our positions are for that. We have a few short-term hedges against, yeah, the best way to hedge that, Jack, would be to sell your house, okay? Really, I don't have an easy way to protect it outside of that, which is why you see Elon Musk selling his house. And I know you like Elon Musk, Jack. So this is a great interview. I highly recommend watching it. Let's see, it's 40 minutes long, a lot of good details. What I really pulled from it was that he says the trade deal is less important than what's transpired with China. Goes into a lot of reason to believe that this did come out of the Wuhan lab, and that he would probably do tariffs to punish them, especially if they don't make good on their deal. So I do think that's coming down the pipeline. But also it's interesting to see him continue to pitch hydroxychloroquine, which I think if given early actually could do a lot of good. And it costs $1 a pill. So if you're really trying to cost effectively fix this, here's the Buffett shareholder. Now his partner didn't make it. It was a remote one. Usually this event has like 40,000 people. It's very popular. One of my favorites, of course, he's promoting Bill Gates and Dr. Fauci, which I don't like considering what we're slowly but surely learning. So that's interesting. He goes on this big rant about, you know, stocks made 100 to 1. The economy's grown 50,000 to 1 in the last 100 years. He watched 6% of the population die from war. We got through that. He's watched all sorts of nasty things, and the U.S. equity market just continues to grow. So it's this big pitch that says, oh, but you know what? I've loaded up on treasuries and sold airliners and don't see anything attractive. does this big analogy about the value of a farm and how he values companies, but then, goes to say that he thinks airliners may not be back to normal income levels for many, many, many years. He didn't mention that, Karen, so I didn't notice that actually, but he is Democratic. He's been pretty, and I think his father was Republican, so he grew up in a political household. But yeah, so he lost $50 billion quarter one, 27%. Okay, so grand scheme of things, we're doing quite well this year. I do want to point that out. In terms of positioning, we have the same overall positioning as Buffett in terms of treasuries with our largest position. He had 180 billion in equities. He lost 50, and then he sold, I believe, another 10 or more in his airliners. So he's probably about right now, he just basically owns Apple, JP Morgan. What does JP Morgan own? Mostly a bond portfolio and mostly treasuries. And then you have some other big banks in there which hold more bond products. So his actual, and you got Geico, insurance company with lots of cash leveraged for that same strategy. So really, he's down to treasuries, big banks that hold bonds, much of which are treasuries, and then he has Apple. Okay, so that's really his positioning now. And what's Apple doing? They're issuing massive bonds to buy back their own stock to try to protect the value. So I think he's willing to probably buy some puts, protect his Apple position, ride this one out. So that was a great speech, 5 hours of content. Again, I will make this one of the boot camp videos to watch Tuesday. 3 people I do enjoy listening to are Warren Buffett, Bill Gates, and Ray Dalio. Even if at times we have to understand their biases. This is one of the vaccines that we will have results on sooner than later coming out of Oxford. So got to keep a close eye on a vaccine. Here's another link I gave you, which has a bunch of clinical trials on therapies and different vaccines, one of which is the hydroxychloroquine. So far, there's really nothing that's really providing a lot of value that's been proven. They're trying to say they did a test on remdesivir and they had to end the test early because the results were so great that it would be immoral to not allow the placebos to not have the medicines. I don't know. It's very concerning that Gilead has so many of its people controlling these government agencies in terms of what they're making for recommendations. So I just don't think remdesivir is going to do much. And for that matter, so far I'm led to believe there's really not much anything outside of your immune system. Now, maybe hydroxychloroquine given very early could be beneficial, but there's not enough data out there to argue that either. New York's very slowly opening back up. Antibody tests, they are the leader in this. And this could make an impact on timelines. So if we are predicting that the plague is going to hurt our economy for 12, 24, 36 months, we want to know when we're going to get herd immunity, because that's really going to control that timeline, that and a vaccine. And obviously the mortality rate. So first we had to ensure that our mortality data was justified, which I looked at the excess death data to confirm that, yes, this is creating an abnormal amount of deaths and lockdowns were warranted. So that's a check. 2, are we near herd immunity? If we're near herd immunity, then this doesn't matter. We need to go back to work. We need to forget about these lockdowns. Okay, so the Arizona, New York have the most data out. Well, New York has the most data completed. Arizona is running 300,000 tests this month. CDC is supposedly doing a blind 100,000 person test randomly picked through the whole country. I think I've already got a pretty good scope of how many people have had this. And I just want to point out, even in New York, there's plenty of counties where a very small percentage of the population has these high antibody counts. So it's very foolish to think this is widespread already and that you've already had it. In fact, the probability of winning your, one of those little scratchers, you have a better chance of winning that than you do having the antibodies at this point. So the only place that had a super high reading was right in New York City. And you got to realize the method for picking these people involved going into grocery stores where people are probably pretty foolish to even go to a grocery store. So I think the sample of this test is going to be leaning towards people who have a higher chance of having it. And thus I do think that around 2 to 3% maximum of Americans have had this, and thus 97% of the population is at risk, meaning we're nowhere near a solution on that front. Excess deaths, coronavirus, ghost, Thanos, I think that's a Marvel character. This is the percentage in increased deaths over the March 1st through April 15th period. Italy, 90%, almost double the normal deaths. Belgium, 60%. So you don't just have a spike. These deaths are happening in a period where throughout history, there's a declining rate of mortality, not an increasing. So we're seeing this huge spike worldwide everywhere this hit. The more dense your population, the worse it was. So pretty confident on that. This was a great interview that Tom Sharp recommended, although I gotta say I had it on my playlist before you sent it, Tom. Just teasing him. This guy admits his timing is always difficult, but he does have great insight into geopolitical landscape. I will be endorsing this for the bootcamp members, but you can find that link below today as well. Our 20-minute interview, essentially pretty pessimistic about geopolitical everything, really. Goes through the currency, all the top currencies really clearly, really gives you good reason to believe the dollar will be extremely strong. Explains the nationalism in China as they go through a very nasty period of time. Talks about age demographics. That's really interesting. Talks about the oil problems, what the Saudis are up to. Really good interview if you want to know just how terrible the geopolitical tensions are. And also it goes through what are some of the strong relationships, namely the U.S.-Mexico relationship, U.S.-Canada. He does expect we'll get one with the Brits. Good interview, hour and 20 minutes, really supports our theories. This is a video from Dr. Med Labs. If you think there's a vaccine or a treatment that will work, I guarantee you'll have the most credible yes from this YouTube channel first. They are excellent. They're actually in the ICUs. He was one of the first to talk about hydroxychloroquine. He also goes through every case study that comes out. And in this video, he's explaining why people with high blood pressure are losing oxygen levels without the cough, without the lung symptoms, and having heart attacks or strokes and dying, and why and how the mechanism for how this plague can not only take out your lungs, but it can also take out your ability to have blood flow. So it can constrict your arteries, cause heart attacks. And so there's a lot. If you saw any footage of Chinese people just flopping over dead in the middle of nowhere, the best explanation is this for that analysis. Great video, highly recommend it, very technical, but if you subscribe to his channel, watch the video, don't try to this channel is for people who want to become doctors. And so I do believe this will be your most insightful source of information in terms of treatment and vaccines, which again, I do for you, but if you like to study as I do, this is a great channel. And again, I think will be the first source for verifiable information as to a real treatment that is providing benefit. So far, there's really nothing that's very exciting. There's a different group of doctors who I do like, Dr. Mike and Dr. Yo. This guy has a nice video, really pleading that he has no connection to any bio companies, that his friends and family are dying, and looks at a new drug, which is covered in this video. But he also goes, which is Laron Lam, another channel I would listen to if you want to really be on top of that. Now, if you want a real bear on the outlook for the plague, then Peak Prosperity has great content. He has his own biases, which I tend to disagree with, but in terms of good content and giving you the most bearish possible outlook as to the future, here you go. So I would look at this channel for that type of content. And a lot of content coming out about Dr. Fauci having been in charge of an organization that was giving millions of dollars to the Wuhan lab, which was, again, going out and bragging about what they're accomplishing, testing these different diseases and collecting them all over the world, trying to get them to go from one animal to another, and all sorts of things that we're now seeing in this current plague facing us. But he was waiting to see other media organizations attack Dr. Fauci. This video does go into pretty good detail on that. So I like that video in particular of his content recently. And again, it's in your Fauci, Dr. Fauci, sorry. Okay, this next video, interesting, White House is blocking Dr. Fauci from testifying to the House. So interesting development there. Okay, Operation Warp Speed's the new hypey name they've put out about getting a vaccination as soon as January. Very skeptical of this news. I think it's more science fiction than science, but I'm keeping a close eye on it as, again, it does change timelines dramatically. In the CNN article, they are saying that they're betting on Moderna, which is also the same company that Bill Gates seems to have an affinity towards, in terms of him mentioning that company quite often with their high-tech technology. So they're trying to make a very advanced type of vaccine, which is very cool, much different than other types of vaccines. So we'll see if that plays out. Here's an article on the Oxford scientists. Again, it's very important to keep track of this data. And then finally, another document summarizing the progress on a vaccine. So again, if there is news about mortality rate, antibody, what percentage of the population already has this, as well as vaccines and therapy treatments, I will, without question, be on top of that data for you and providing you all the reference links to do your own due diligence. Abby's saying, who is the first guy on YouTube? Jack wants to know if I'm a Republican or a Democrat. I would argue that I am not for either party, and really have at our best interest just trying to make us money. So I would hope that you would believe I am not making biased decisions based on being affiliated with either party. Now, I will say in general, I think you can see I'm much more of a Republican by nature than a Democrat. Jack says, do I like Trump? Well, there's things I like and don't like about him. I like his policies against China, at least until December. Then I felt like he kind of bent over and took a deal that obviously is not paying off for us now. But I'm not afraid to critique Trump, and I think you have seen that I will critique anybody I disagree with, regardless of affinity, from Buffett to Ray Dalio to Bill Gates to Trump. Barry wants to see the precious metals. Okay, we're going to get there, Barry. Very good question. I do want to start off at the bigger markets and work our way down to the little markets. So we started off, as you can see, first trying to figure out what's going on in the economy. Is it going to be growing or slowing down? And I think quite clearly we can understand why it's slowing down and not growing at this point in time. So that's the most important thing to figure out first. So let's pull up our stock charts now. I'll try to do this quicker. I know you guys have seen this. This is Jeffrey Gundlach's big play. The big picture here, okay, yellow is Japan. Japan was going to be the biggest economy in the world, overtake America in the 80s. Government took advantage of their wealth. Real estate prices went high. They issued tons of debt. Labor costs went up. Guess what? The companies got out of Dodge, and Japan had a huge stock crash, real estate crash, lasted for many decades. They went to negative rates, and they chose to protect their currency and their bond market and not try to expand as territory. Okay, so they remained the third largest economy 3 decades later. I'd say it did all right, although a lot of people critique what they did. But look, they remained a superpower. We come into the dot-com bubble, but this was really the big run up for the euro. This is when Europe was going to team up and be more powerful than anybody. And we all knew how that ended up. So Europe did the best in purple here, outperformed all other markets, crashed, didn't rebound for decades to come. And what I want to point out is the prediction here is that America, as we see, that any index that outperforms too much will have a expansion of debt that causes it to underperform for much longer. So we're coming into that. China here in the 2008 crisis. So China was taking over the manufacturing from Japan and for the world, the factory of the world, but they only had a handful of cities. So they said, all right, let's go replicate what's working across all of China. So they were crazy. They were building as fast as they could. Houses, skyscrapers, they overbuilt. Bottom line, they built too much. So they had a good thing. They took it too far. It caused a huge real estate bubble. At the same time, we did the same thing in America to a smaller degree. And you can see they outperformed. The turquoise and the pink are pretty correlated. Emerging markets and China specifically. And you can see they outperformed other markets by many multitudes. So huge outperformance in emerging markets in this period. But then it became clear that they had overbuilt, and China nearly went bankrupt in 2015. They did massive money printing, got another pop out of that, but short-lived. Okay, so China never really recovered from the 2008 crisis, and that's because they put all their eggs into building these massive cities for factory after factory after factory, and they overdid it. They just did way too much. Now they want to do the same thing with the Belt and Road Initiative. So what market did the best in this decade? By far, without question, the US stock market. So Gundlach's prediction is that now we will be in a decade of pain potentially. And that's again from too much debt. Really, it's the debt drags on growth. Okay, so it's a big picture of the markets. In this chart, we're looking at the stock market versus the bond market, TLT versus SPY. I just want you to see if stocks crash, TLT spikes. Stocks crash, TLT spikes. Stocks crash, TLT spikes. Stocks crash, TLT spikes. Stocks crash, TLT spike. Okay, so that's really the correlation you need to understand with your biggest position following our strategy. Okay, now, does the stock crash actually make the bonds go up, or do the bonds going up make the stocks go down? Did the chicken lay the egg, or what was the order of that, right? So I would argue that here's what you need to know about the bond market. Bond market goes up when the government grows its deficit at an accelerating pace. So I'm not talking about going from 1 trillion to 1.1 trillion to 1.2 trillion. That's a relatively low growth rate. Okay, your bond market's going to go up. The TLT specifically is going to go up when you can predict that the government's deficit is going to grow at a fast pace. So we're talking about going from $1 trillion deficit last year to probably a $2 to $3 trillion deficit this year and a $3 to $4 trillion deficit next year. That's the big picture. And because of this growth of the government's deficit, all the money is going to be flooding into the bond market and out of the stock market. So my prediction is the TLT will be the best performing asset with the least volatility for the foreseeable future, for many years to come. And that's because of predicting that the government would grow its debt at a growing rate, at a rapid rate. And so when this first began to play out, they were throwing out $8 billion stimulus package for the plague. And I said, oh no, this is going to cost trillions. Well, 60 days later, they have promised 2.4 trillion, and they're just getting started. Our deficit, according to Goldman Sachs, their estimate last week was that it'd be between 2 to 3 trillion this year and grow even larger next year. So that prediction is correct. We'll talk about the timing. When do we actually see the profits in our pockets on the TLT? We'll talk about that timeline. Karen says she's a patriot. I like that. I'm a patriot too. Okay, TLT chart on its own. So I do want to point out the last leg down, which was vicious, but still not that large, got us from, well, the run-up really began in January. I think some people knew the chaos ensuing in China far sooner, but the last big move pushed us from 140 to 180. Okay, so, and that's a big percent change right there. So I think we can see a much larger percent change in the next leg down. So let's see where that, so this was a percent change of approximately 30% this year at the max, currently up 20%. But you can see the treasury market is not pulling back when stocks have just rallied so aggressively in April. So I think we, in the next leg down, should expect a similar move to the upside. So I'll calculate where that is, but I do think my last few weeks I was telling you, you know what, we missed taking some profits at 180. We're going to do it next time we get near that. I've changed my thoughts. I think we're going to blow past 180 in the next move. So I'll have to find exactly where I want to place our new call option strikes and the timeline for those. But I am getting to a position where I think we're going to blow past 180 on the next move. So keep that in mind. And again, if we can understand, why is the government blowing out its deficit? Well, because the entire economy was, you know, this is not like we've had a hiccup in the economy. We pulled the whole economy off the tracks. We just stopped it completely. So that's why the government has to spend all this money. So that is a massive increase in deficits, and why everybody who's smart, from Warren Buffett to JP Morgan, is loading up on treasuries. And again, we'll talk about timelines in a little bit. But if you get that part right, the rest will be easy. Here's again the SPY overlaid against the TLT. And I just want to point out here, TLT went up during this period where the SPY went up. That's highly irregular. Okay, so that's only because of the QE that came through, $2.5 trillion. So my expectation is, again, S&P 500 crashes violently, and the TLT has a nice steady grind as long as the government is growing its debt at a exponential rate, which for the next 2 years at a minimum it will be. Okay, in this chart we're looking at gold miners against emerging markets. So emerging markets and gold miners tend to do very well during periods where there's a weak dollar. So starting out the year, I was expecting a very weak dollar, an extremely bullish emerging markets, and even more bullish gold miners. Okay, so we can see these are highly correlated. Well, now my opinion is that emerging markets are in a lot of pain and that we're going to have a very strong dollar. So this again is very bearish for emerging markets, as well as, unfortunately, gold miners. So we'll take a look at that timeline and strategy once we get to the inflation deck. But I do look at gold miners as a leading indicator for a stock crash. So we'll actually want to potentially buy our in-the-money GDX put before we put the SPY put on, time-wise. I could potentially do that. I think an even better, perhaps the best leading indicator we have outside of China devaluing its currency, which we know the American administration hates. But I think these will be your two best leading indicators. One is watching Ethereum, which is just a super lightweight digital currency that is easily manipulated. And the reason why I like to look at Ethereum is because the same people who are systematically buying and selling stocks are also systematically buying everything correlated to it, which includes cryptocurrency. So a lot of people think that you should buy something like Bitcoin to protect against a stock crash. I think that's the exact wrong idea. In fact, without question, I believe that. So I would look for Ethereum to viciously sell off with Bitcoin at the same time as a heads up, trouble ahead in stocks, as well as watching, again, the Chinese currency devalue itself, which is usually a heads up as well. So those are probably the two best heads up we'll have before the big next leg down. So far, those two assets are not showing a lot of weakness right this moment. So I don't think we have a crash tomorrow. The thing is, they will drop like a rock in a moment's notice. So it's not going to give us a lot of heads up. Okay, so here's that same chart we're looking at. And again, during this period with the SPY going up by about 20%, we should have seen the TLT sell off. Now here's what's abnormal. The TLT sold off with this SPY, and now it's rebounding with the SPY. So that's a highly abnormal period for both moves right here. This was primarily big central banks having to liquidate treasuries to get dollar funding because they were completely out of dollars. This move up is from quantitative easing. So usually QE is great for stocks, but terrible for bonds. And I'll go into the analysis of that in a little bit here. But this time around, the bond market didn't budge with the QE, meaning people are buying and holding their treasuries and sitting back as they anticipate the value of this to go much higher. If the Chinese devalue their money, TLT goes up. Yeah, so here's the main correlations, Jack. TLT goes up if the government grows its deficit. So that is happening without question. So I really don't think there's anything that would change my forecast in the bond market. Now, does that necessarily mean the stocks crash? No, not necessarily. When will stocks crash? As people sell stocks, okay? And right now, the biggest support for stocks is the banks being able to sell some treasuries to the Fed and not risk a spike in yields. So we're seeing 8 billion a day in QE in the treasury market. So I do think that's really your main source of liquidity, keeping stocks at this level right here. So TLT will go up if government increases its deficit. That's a check mark. TLT will also go up if stocks crash. So that's a similar correlation. If the dollar's strong, stock market will likely crash if it goes too high. If the Chinese devalue their currency, that's another thing that makes the dollar strong. Gold is highly correlated to stocks. Okay, so we'll look at that chart. So those are your main correlations. Oil. Okay, in this chart, we're looking at the yield curve in a not in the typical format. So we're just looking at linearly the yield of the 30-year, 10-year, 2-year treasury. The 30-year tends to chase the 2-year. So the lower the 2-year goes, the lower the 30-year yield goes. The lower the 30-year yield goes, the higher the TLT goes up. So we do want to see a nice spread to believe that that this can go lower. Okay, so note right here how they got quite tight. Notice how the 2-year went way below the 30-year in this period and eventually has drugged these much lower. But also the 2-year was spiking here, giving us a bit of a heads up. So the 2-year is your best leading indicator for the 30-year. Another metric to look at in the bond market is another metric to watch is competing 30-year bond markets, mainly China, Japan, and Germany. So China is sitting on a pretty 3.3 bond, a tiny piece of the pie in the bond market. America really hogs most of this market. But the lower the Japanese and German yield goes, which is currently negative for the German bond. So you actually have to pay Germany money for the right to lend them money. And the reason why is you're predicting that their economy is going to slow down. So they'll have to drive rates lower and then buy your bond back for a profit. So they're betting that yields will go even more negative. That's important for us to predict the extreme of how far the TLT could travel. And the bottom line is nobody's going to loan the US government money at a 1.2% yield. So they're only doing it with the anticipation that they can lend the government money, wait a year or two, and then the Fed will buy it back with QE for a profit. So that's why so much money is flowing into treasuries right now. Not for that 1.3 yield, but they want to flip the bond for a profit. FXI is the 30-to-1 put option we have currently. I think at a minimum, we could go to the 2009 low on FXI. And at the best case, they delist this puppy. And again, you get $31 minus your cost for the put. C-Bond is a new ETF I'm looking into as a way to play, to short the Chinese bond market, which has a lot more room to go lower than the US based on that 3.3 yield. So keeping a close eye on that. Copper goes up when we're building things, and gold tends to go up when we're devaluing currencies or have inflationary risks, which again, devaluing currencies causes. And this has been highly accurate at predicting 10-year yield. So we can see this is pointing straight down, even though it's kind of flatlined a little bit here. The general picture is that a lot of downward pressure on yields. So that's again bullish for the TLT. If I was seeing this spike up, I would be concerned. Here's the yield curve that we're more familiar with. So here's the inverted yield curve in January. The Fed reacted by doing rate cuts, driving the front end of the yield curve lower. And we've seen that long end chase the front end of the curve. So we're seeing foreigners fight over the 1 month, 3 month, 1 year T-bills right now, which is interesting because they weren't previously. The Fed was picking them all up. So we are seeing that the US is starting to sell some of the short-term debt to foreigners, which is good, but really they need to roll this into longer-term debts. So I anticipate that will be, well, here's our schedule. So they're going to announce the new 30-year bond issuance on Wednesday, and they will auction it on the 13th. So we'll see if they get brave enough to start increasing the size. Normally they sell about 18 billion a month, once a month. But now we have trillions we need to sell into this. So I think really that's going to be the moment in time when we really see these big moves, is when they start to roll over these T-bills, which is so far where all the debt's been increased, and roll it into the notes and the bonds. And that's going to put a lot of pressure on stocks. So we'll see that update on Wednesday with the size. Are they going to start getting aggressive, or are they going to keep it with a modest 18 billion again? Okay, so the big picture again, we have two main policy tools by the Fed that we need to really be aware of. One is the cost of money, called the federal funds rate. And then the other is called quantitative easing. This is where they buy treasuries. Okay, so it's opposite what you would think. Rate cuts are great for bonds. Quantitative easing is great for stocks. Okay, now this time around, we could only cut rates from 1.5 down to 0. So they could not get the normal 500 basis point cut that they usually do. And that rate cut in itself did not stop the market from selling off, as you guys know, in March. So then they came in with what they usually don't do, QE early. So usually, here's what happens. Banks go about loaning money in a very reckless manner, trying to make as much money as they can until they have made so many bad investments that you have a systematic risk to your economy. So this happened in 2000, it happened in 2008. Now, instead of letting the banks go bankrupt or lose a bunch of money, instead, what happens is the government bails them out. So they do this with issuing lots of debt and bailing out the part of the economy that's at risk. So in 2008, for example, that was mainly in the mortgage industry. They took bad loans to people who couldn't afford their houses, let them buy multiple houses, leveraging the value of their previous house, creating a huge housing bubble. And then when people stopped paying their rent or their mortgage, rather than let the people who are making a ton of money issuing those loans face the penalty of making bad investments, the government came in and bailed them all out. So they did rate cuts, which essentially incentivizes banks to buy treasuries. So here's the sweetheart deal when you do rate cuts. So JP Morgan has to buy all the treasury issuance we can't sell to foreigners. They're called a primary dealer. So here's the scheme they have. Cut rates to below the yield on a treasury. So now JP Morgan can borrow for free from the Fed, buy the treasuries auctions for a profit. Then they can hand them back to the Fed in the repo market for a new loan and hold that bond. Okay. The government's going to take this money and plug all the holes in the economy. So that's what they're doing right now. And we have a lot of holes to plug. It's going to cost trillions and trillions, maybe tens of trillions of dollars by the time this is over. And to force these banks to hold their treasuries, they have to not do QE. So they have to make them hold those so that they can raise the capital they need, fix the economy, and then the Federal Reserve does quantitative easing, lets JP Morgan sell those bonds for a huge profit because yields have dropped, and then they can buy stocks at a discount. So I do believe they will use the same game plan they always use. The only difference was that this time around, we had so many things collapse at the exact same time, from oil to stocks, where everybody was completely unprepared, not hedged, completely taken off guard, from central banks to Ray Dalio to Buffett. The richest people in the world, the best managers of money, all got hit so hard that they had to sell their treasuries. So we actually saw them do something abnormal, which is quantitative easing early. And if they had not, the entire world would have had to liquidate their treasury position to stay solvent. So that's why they did big QE. Now, what happens is these banks get a big profit on their treasuries and they have new ammo to go buy stocks. So when the money supply increases, stocks go up. But again, the trend has been for them to stop doing QE. Yeah, so really the bottom of the crash is due to the banks coming in and buying stocks with all the money they made from their treasuries. So the bond market's causing the crash, and the bond market's causing the bottom based on the Fed cutting rates to force everybody to buy the bonds. And then they come in with QE and the threat of raising rates, saying that the economy's fixed. So everybody has to get out of those bonds and then go buy stocks. So they're really forcing the money flows with these two instruments. So yeah, the most abnormal thing is this massive $2.5 trillion in April. This was done because of how bad the crisis was. And I do believe they will slow it down and stop it. Otherwise, no one's going to hold their treasuries. Government's not going to raise the $2 to $3 trillion deficit, and we're not going to fix the economy. So there's those two critical charts. Now here's a 100-year look at the Dow and the 10-year Treasury. So I want to take a look at this. And let's just point out this. Here's two periods of time we need to be aware of. First of all, 1929, Great Depression. We started the let's see, got to go all the way back to 1926. We had relatively low inflation, went negative. So we're having deflation, and then it really fell off a cliff in the Great Depression right here. You can see deflation prints in the -2, -9, -9.9. And so I think the housing market's a great example of deflation right now. What happens if you think you can wait a year or two and buy something at a substantial discount? It's going to cause you to save. So there's a lot of highly priced assets where there's good reason to believe if you just wait, you're going to have a better price. So stock market, clearly, I don't think profits and earnings are going to grow anytime soon. So that makes me want to wait. What about housing? Well, if we're going to have unemployment in the 10 to 20% range, and we're going to have a huge section of commercial real estate go, the companies renting that real estate go bankrupt, well, I got to bet that real estate prices are going to go down. Okay. Also, the demographics. We have a lot of people who are going to be downsizing compared to new families who are going to buy those houses. So the general picture I see right now is that the most inflated assets have a very deflationary pressure for the foreseeable future. So I do think something of this nature is more in the cards than inflationary risks. Okay, so that's a very important period. This is very bullish for bonds, very bearish for gold and stocks, as well as oil. Now, the other period of time we want to be well aware of is the inflationary period of the 70s. So 1965 through 1980 is another good time period to be concerned about, as both of these environments require a very nuanced investing strategy. So from 1965 to 1980, we had runaway inflation, getting all the way up to 11% inflation. So that's going to do the exact opposite. So the Fed tends to hike interest rates if we have inflation and cut interest rates if we have deflation. Now let's talk about deflation and inflation. So here's what happened in a deflationary period, the worst stock crash in history, and it lasted for 4 years. So Buffett spent a good hour talking about that in his shareholder briefing, and he's worried that we're heading towards a period like that. But what happens in a deflationary period, or rather inflationary period? So that's not good for stocks either. So stock market does well when there's just low inflation, not high inflation and not deflation. So 1965 through 1980, you lost money the whole time with a few rallies that might have made you think you're okay, but at the bottom of the day, if you bought 1965, you didn't get back to even until 1994. So you lost 30 years to get back to even. And the purchasing power in 1965 is obviously a lot more than 1995. So probably you didn't get back to your purchasing power until the dot-com bubble, and then you got to watch it crash again. So inflation and deflation create a big problem. What happens to bonds during an inflationary period? Well, remember, if yields go up, then the bond value goes down. So we don't want to be buying bonds unless you like the yield all in itself during an inflationary period. So with what's happening, I could easily see us overshooting the deflation and then going straight into runaway inflation. And if that does happen and the Fed's not super careful or isn't willing to hike interest rates, then we could be looking at decades of very difficult trading periods. Okay, so now we're coming along to these charts. Here's USO. It did the split. So, oh, let's see. They've actually added more data based on. Okay, so here's your longer chart on USO. It crashed from a relative 100 down to 20. Massive decrease in the value of WTI, the underlying futures traded in this. It was dramatically pushed lower on a May contract, going negative for a short period of time. I don't think we'll see that again. Here's those future contracts we're actually trading now. They've been changing the formula, but the bottom line is we want the short-term value of WTI in the futures market to spike while the long-term remains relatively flat. And so if we zoom out, we can see the discrepancy in price just rarely ever happens in time. And this has been, here's where this crash happened. We entered the next morning, and now we're seeing the spread slowly tighten up. Okay, so what we really want is for this to cross over. And again, the catalyst for this would be, first of all, the cause of this crash right here in the red line was the fear that we would run out of storage. That was really the main cause. Okay, so we had demand collapse, we had supply stay flat, and then storage ran out of room. So now we have the U.S. government planning potentially to create 100 to 200 billion dollar storage, billion barrel storage capacity, and to bail out the oil companies. So that's exactly what we want to create that short-term price change. Rick says, why don't you have more TLT? I have almost half our portfolio in the TLT, which is the same as Buffett. So I think it's a pretty good ratio. Yeah, I wouldn't look at moving averages to try to predict the mechanics behind. Well, I wouldn't use moving averages to predict anything for that matter, but especially not the bond market, Rick. Bond market is driven by central banks and governments. Okay, so if you think JP Morgan's going to go buy $1 trillion of government debt and lose a bunch of money, go check their profit and loss over the last decade and see what they've made all their money from. It's mostly from bonds. Okay, so here is a bigger oil market, Brent oil. Big picture here is the Saudis seem to be trying to put everyone out of business so they can have a higher profit margin in the future. And so they did that curious Aramco IPO, raised a ton of money, and now they're out trying to put everybody really into bankruptcy in the oil industry. So that's why I like the USO play. You got the Saudis really making the long-term outlook really horrendous, and then you have the U.S. government giving you that short-term spike. So that's really the double combo for USO. So we have until January 15th for that to occur, but I do think it'll happen sooner than later because the oil crisis in itself can cause a stock market crash. And this chart, we're just looking at TLT against oil. Note that when oil crashes, TLT goes up. Okay, if oil goes down, stocks tend to go down. So we saw a stock market go up from some manipulation from the central bank, but oil didn't buy it. I would really look at oil. Without healthy oil prices, your economy is not really strong. And so commodities are really a good giveaway, especially oil, for whether you have a healthy economy or not. So I'd like to see oil back above 50 before I was worrying about inflation or anything of that nature, or thinking stock market was back on track. Okay, so now we're going to gold. Here's your big look at the price of oil. A lot of people are just looking at charts thinking this is ready to break into new highs. I don't think so. I'd highly doubt we go above 1746 anytime in the near future. So my expectation is, again, that stocks will crash and gold will. In this chart, we're looking at the S&P 500 against gold. And I do want to go back to 2008. And so when we had a little bit of a pullback in the 2008 crash, we saw gold rally for a tiny bit of time. But then gold did head lower with the value of the S&P 500. Now, did it do a good job holding value? Sure. But did it go up when stocks went down? No. So I don't think I would expect that this time around either. If we go to a more short range, on the most recent crash, stocks went down. Did gold go down? Yes. Did it go down less? Sure. Did it go back up with stocks? Sure, it's going. So you can see they're extremely correlated. So I would not be too bullish on gold at this point in time. Okay, so now we're comparing gold, gold miners, and spot silver. So let's talk about this correlation and what I'm hoping will happen. So if I'm wrong and all the central banks decide, you know what, we're just going to do QE for much longer than anybody anticipated, we'll worry about selling the debt much later, they'd never stop QE. That would really be a concern for our strategy at this point in time. So gold miners could go up, I would agree, if we never stop QE. But then again, you're not going to actually sell any government debt to foreigners because no one's going to make any money from it. They're going to lose money. So we'd have to just put all the debt on the Fed's balance sheet and not on banks' balance sheets, which then raises concerns about the dollar, which then again could create a new crisis in itself. So I think it's highly unlikely that they don't stop QE. That would not really follow the game plan of how to fix the economy. So unless they were absolutely trying to destroy America, they have to end QE to raise the money for the government, to plug the holes in the ship, to allow the banks to make money, loaning capital to the government. Okay, if they don't stop QE, the deficit will not be sold, and a lot of other problems arise. And we're seeing the Fed reduce the growth of QE every week. So I think it's just a matter of time, not if. So with that in mind, what's our plan? Well, I would say we're buying GDX right here in orange, maybe at this leg right here in the crash. If we're just comparing this crash to 2008, my plan is to sell your puts when I think we're near this moment in time, the bottom, and then to remain long GDX. This is going to allow us to get to that year time frame to buy and hold way before the rest of the crowd, because we want to jump into the next big move way before the rest of the crowd, which I believe will be silver, spot silver. Okay, so we get a shortage in silver. We get these assets getting very frothy in value during a recovery, inflationary problems, not deflationary problems. We want to be able to buy spot silver way before the crowd does. And then if we do get another huge spike, which I think we will, be the first to sell as well. So that's one reason I do like GDX. Not only if I'm wrong about the QE, will GDX provide some profit for us? If I am correct, we can sell our puts for a big profit at the bottom, and then be well along the way to selling our GDX shares before everyone else at the lower tax bracket, and then rotating into the next play. Okay, so that spot silver play was massive return. I know people have made millions in this run right here. So I do want to get us heavily invested in that run up. But we need inflationary pressures. We need the economy to be fixed. We need everybody going back to work. We're not going to have inflationary pressures with, 2 out of 10 Americans unemployed and on food stamps or unemployment or something of that nature. So it's really critical for precious metals that we have inflationary pressures. Okay, dollar index. This is a great indicator of emerging markets. So if the rest of the world's not doing so hot, they need dollars. They are selling their own currency to get dollars. Okay, so the higher that goes, the worse shape emerging markets are in. And again, strong dollar is great for bonds, bad for stocks and gold. 98, below 98 would be a relatively weak dollar. Anything above that's a relatively strong dollar. What about individual currencies? Is anything going to be better than the dollar? Japan, no. China, no. The pound, no. Australia, no. Europe's the worst. There's really no alternative to the dollar. Everything's really quite a joke. So I have very little fear in the foreseeable future of a weak dollar, and no intentions to invest in other currencies. And so if we do zoom out on this one, we can see the general trend is that the world needs their dollars, and over the last 8 years, they have weakened from anywhere from 5 to 34% against the dollar. And that's really the big trend, is that everybody issued their debt in dollars. They do all their trade in dollars. And when push comes to shove, they have to convert their currency into the dollar, which weakens their currency just so they can pay their interest. Abby's asking how USO went from 250 to 17 in a week. It did a reverse, it did a split, Abby. So it's actually not changed its value. Let's see. So when it did the split, I think it was at 250 and it did an 8 split. So it went to 20. So we're basically flat from that 250 level if you entered at 250. Now, regardless, every member who's following my trade, you took your maximum loss the second you bought your put. You can't lose a penny more. So we're not worried about what USO bobbles around at. Could care less. All we care about are the two catalysts. One, is Saudi Arabia going to drive the long-term outlook for crude down? Check mark, yes. Is the demand for oil going to remain low for the foreseeable future? Check mark, yes. Is the American government going to protect our ability to provide our own energy source? Yes. Now we just need them to take actions, one of which will be increased storage. We have too much. We need a place to store it. And then 2, we need to pay our oil drillers to stop producing for a while, to slow it down so that we can get the price back up. So I really like that USO play. And again, you take your biggest loss possible by buying the in the money put. All right, guys, we made it through all of our charts. So go ahead and take questions now. And I do have a new set of slides coming out, a lot of slides. So we're going to reserve those for the boot camp episode this Thursday. And we'll see how far we get on the tutorial guide for your spreadsheets this Thursday. Let's see what questions we have now. Okay, let's see. Bill Richardson asks, when does JP Morgan buy after the crash? Yeah, so again, it's more like the banks caused the bottom of the crash to end, and that's from them selling their bonds for a huge profit. Now they have capital to go buy stocks, and so that's what's causing that. Hi, Jason, is the 28 put new? So here's the positions we have on GDX. So we have 400 shares of GDX per 75,000. We're protecting it with the 821 GDX 28 strike put, 1 put option per 100 shares. If you don't have that, yes, you should have that. Now, you could potentially have our old position. So any positions that are old, they're a hold, but not a buy today, I have at the bottom here. So that 23 put is worth very little now, probably a penny. If we have any volatility between now and that expiration date, I'll sell it. Otherwise, I don't mind it just expiring worthless. And coming up, I'll probably buy a 35 strike put option on GDX on top of your 28 for further protection, because I do believe that gold is going to get absolutely hammered here in the near future with cryptocurrencies as well, unfortunately. And I know there's a huge catalyst that has everybody's eyes kind of stargazed with the Bitcoin halving. But the problem with these sectors is that they're just so tiny. Market cap on Bitcoin's 163 billion and Ethereum's 22 billion. So the gold market's like 10 trillion, and global stock market's something like 50 trillion. The global bond market's about 122 trillion. So you can just get a feel for the magnitude of each market cap. So again, if you want to have a good heads up, it'll be that Ethereum. Once you see a 10, 20, 30% down move on Ethereum, I would expect that the big players are actively dumping stocks and that they're systematically selling everything correlated to it. So that'll be a good heads up. Another one is, again, that Chinese currency devaluing. Let me pull up a chart of that real quick. And I'll get that on our daily I'll get a whole slide just for that one coming up. So boot campers have let me do it the way, so the media likes to, I like to look at it in pennies for our trades, but the market likes to report it the opposite. So if we zone out to every time there's a threat for tariffs, the Chinese want to offset that threat by devaluing their currency, which makes the relative cost for American importers or Chinese exporters to really kind of reduce the cost of the tariffs. So they do that anytime they're threatened with tariffs, and they really do it when there are new tariffs. So if you're in the boot camp, right now I'm looking at the threats more of a cat fight. I'm not quite buying that we're ready to take this to the next level yet. I think we're perhaps, we'll see. The second I see tariffs actually being applied, not only will our Hong Kong trade potentially get near a profit target, and also I may increase that risk. I might actually dabble on shorting the Chinese currency too. So that's quite a big devaluation they just did right there. But also every time they start to devalue, people get pissed and they start liquidating stocks like clockwork. So we'll have to keep a close eye on this daily now as we're seeing this start to move. But yeah, I do want to end by saying, look, we have a 4% drawdown in 2020, a great March, a horrible April, the $2.5 trillion of QE. I didn't react too quickly. I should have. Take full responsibility for not reacting to that. You guys know I love tracking that print. But now they're not doing that same level of QE. So I don't think the same move in April is the best move in May. I have a 1% upside bet on QQQ and about 3% on us just trading flat. So we have a hedge if this April trend continues into May, but we're really positioned in general to thrive from stocks crashing and bonds rallying. So that's where most of our capital is set aside right now. All right, any last questions? We've gone for Chris. Okay, Ian is asking if I'll be buying VIX call options as the market crashes. No, I prefer to, the VIX is pretty expensive at 40. I do think it's going to spike. I prefer to play the VIX as a upside hedge for us and to buy those out of the money SPY puts and the TLT call options. So I probably won't be buying VIX call option, but because I already have so much of our capital making the same bet. But that's not necessarily a bad trading idea, nor does it argue with my general theme for how we're playing the markets. So that's. All right, guys, very good. We will see you guys back on Wednesday. Do expect tomorrow an update. So if there's anything to change in your portfolio, you'll know tomorrow with an update. If there's nothing to change, you'll know with an update. If you're in the boot camp, you're going to get a series of videos and articles to study, the best of the best over the past week that I've gone through, which is usually hundreds of hours of content whittled down into about 5 to 10. On Wednesday, we will have our next webinar. And again, I do expect to sell that VIX put expiring this week. And we're carefully monitoring the oil situation. That's one thing I would like to see resolved before I add another expensive put on the SPY. So I want to see that resolved. I think that can happen in the next 2 weeks. I also want to see the Fed continue to ramp down its QE. It went from 10 billion a day to 8 billion. That's a good move, but I would like to see it go even lower. Ram says, do we have the cheat sheet available? No, I'm hoping to get most of that done tomorrow. And also, we're going to hopefully have your spreadsheet linked in the top of your email starting on Wednesday as well, I hope. So you'll have the tutorial video and the spreadsheet hopefully by Wednesday at the top of every email, so you can easily find your spreadsheet. And then Thursday, we have a huge set of slides to release to boot campers. Should be a couple hours of content, very similar to the Jeffrey Gundlach quarterly presentation. Actually, it's exactly like that, not gonna lie, 100%. And we're gonna have that updated very often, as frequently as the data updates. So much better than waiting every quarter. Also with the Jeffrey Gundlach thing, you can't even find the replay for weeks until their legal team reviews it. So we'll have this freshly updated on a monthly basis. And you'll get a copy of all those slides. So big things coming in the boot camp this week will be hopefully a lot of progress on the written tutorial for the spreadsheet tomorrow, which will release Thursday, and then expect a very similar presentation Thursday for boot campers based on Jeffrey Gundlach's very famous quarterly presentation, which was a lot of work to get that together. So I think you guys will really appreciate that. Okay, great. We'll see you guys on Wednesday. Tomorrow, you'll get an update. If there's anything to worry about, you'll know. If there's nothing to worry about, you'll know with the update. If you're in the boot camp, you're going to get a good 5 hours of content to study, which is, again, out of hundreds of hours of content that I've gone through each week. So you can focus your energy. Wednesday will be our next live webinar, and we'll go from there. Thank you so much. Appreciate everybody. See you Wednesday.